Hello champions, I hope you are doing well. So listen to this introductory video very carefully and then you can start with the main part of the video. See, this video is something very similar to what I had uploaded even before the Jan 26 exams. So before the Jan 26 exams also I had uploaded a video which contained all the new and unique questions from the September 26 question paper and the Jan 26 RTP and MTP. Now, these are the new unique questions which you should be knowing before you walk into the examination hall. The exact same thing I've tried doing now as well. In this video, you will find all the new and unique questions from the Jan 26 question paper and your May 26 RTP and MTP. So what I've done is, I've divided this entire video into two parts. In the first part of this video, these four things will be covered. That is your Jan 26 question paper descriptive part, the May 26 RTP and the May 26 both MTPs. This will be covered in the first part. And this will be covered chapter wise. Okay, I've divided these questions chapter wise. So I will finish these four resources for you first. Now in these four resources, from the RTP and MTP, you will not find too many questions because this time the May 26 RTP and the MTPs, there are not too many unique questions. Most of the questions are repetitive questions which we've already seen in the past. Like multiple questions from the mock test papers especially are from the Jan 25 resources. Okay, so whatever were the new and unique questions over here, I picked those, and all the Jan 26 question paper descriptive questions, I've discussed this first chapter wise one by one. Okay. Then after all this is done, towards the end, you will find me discussing the Jan 26 question paper case-based scenarios. There are 6 case-based scenarios in the Jan 26 question paper. I would have discussed them. Now, this is going to be your list of new questions. Before you walk into your May 26 examination, you should be seeing these new questions. Total put together, there are 35 new questions, okay? All of these new questions, some MCQs, some descriptive questions, you will find them all discussed in this video. Now, the questions PDF, which I will be using in this video, you can download that from my Telegram channel. I will put the link to that in the description below. Got it, guys? So this is a really crucial video covering all the unique and the new questions. It is a must-watch video. It will not even take you too much time. In around 2 hours, you will be able to finish these 35 questions. Only 35 questions, guys. At this stage, in these 35 questions, please don't compromise even one bit. Alright? So after this, the 35 questions we will start with one by one. Starting with the very first question over here, this is a May 26 mock test paper question. The question says, Seva School started imparting education on 1st April 2010 with the sole objective of providing education to children of weaker society, either free of cost or at a very nominal fee, depending upon the financial condition of their parents. So basically, we're talking about a school over here. However, on 30th March 25, it came to the knowledge of the central government that the school was operating by violating the objects of its object clause, due to which it was granted the status of Section 8 company. So this school is a Section 8 company and the Section 8 company is violating the objects of its object clause. This will become a ground for revocation of license, guys. Describe what powers can be exercised by the central government against a school in such a case. So very simple concept. I'll remind you about the concept first. The very first question over here, the concept goes like this. So if it's a Section 8 company, it first of all requires a license, guys. Now this license gets revoked in certain situations. When does it get revoked? There are 4 situations. Situation number 1, when the Section 8 company contravenes the conditions subject to which the license was issued. Situation number 2, when the Section 8 company violates its objects, basically if it starts doing activities with profit motive. Then number 3, when the Section 8 company does activities which are fraudulent. And lastly, when the Section 8 company does activities which are against the interest of the public. That is, the Section 8 company's affairs are prejudicial to public interest. So these are the 4 situations in which the license will get revoked. Now to revoke the license, central government will not directly revoke the license. There's a process. Central government will first give a written notice to the company saying that the central government intends to revoke the license. Then an opportunity of being heard will be given to the company. Then only license will be revoked. Once license is revoked, the central government will pass an order. What order? There are three options. Central government will pass any of these three orders. Either central government will pass an order saying that this Section 8 company will now be amalgamated with some other Section 8 company having similar objects, or the central government will pass an order saying that the Section 8 company has to be simply wound up, or the central government will pass an order saying that the Section 8 company will be converted. It will be converted either into a public company or private company. So this is exactly what this question is about. Even in this question, if you see, this school has violated its objects. So because the school has violated its objects, it is clearly falling under this part of the situation, guys. So because the Section 8 company is violating its objects, on this ground, the license can be revoked by the central government. So they're asking what powers can be exercised by the central government. Central government can exercise the power of revocation of license, and this will be the entire process which they will follow to revoke the license. Simple, guys. So this question is purely about revocation of license of Section 8 company. Then come to the second question. The second question is May 26 mock test paper question again. Now this question is also about our Section 8 company. This is a simpler question. The question says Mr. Purushottam, along with his 6 friends, desires to incorporate a Section 8 company under Companies Act 2013. Okay. He is seeking your advice in the following matters. What is a minimum paid up capital requirement? There is no such minimum paid up capital requirement, guys. Earlier there was a condition that Section 8 company should have so much minimum paid up capital, but there is no such minimum paid up capital requirement anymore. Then second question, whether a firm can be a member in Section 8 company? Yes, in a Section 8 company even a firm can be a member. Then whether Section 8 company can pay dividend to its members? This we know very well. Section 8 company is prohibited. It cannot make any distribution to members. It cannot distribute dividend to members. Also, when the Section 8 company is winding up, it cannot distribute surplus assets to members. It is prohibited. This was a simple question. So both of these questions in our basic concepts chapter were connected to Section 8 companies. Now come on, guys, come to our third question. This is from your Incorporation chapter. Let's have a look at the question first. The question is from your Jan 26 question paper, guys. The question says, a group of 5 professionals decided to start a private limited company, okay, in the anti-drone solution sector under the name D-Drone Private Limited in April 25. So it's a private limited company. Company wants to have its registered office in Mumbai, okay. On 2nd April 25, it applied for name reservation through RUN, Reserve Unique Name, and it received approval on 6th April 25. So this is when the name reservation is done. Now we know very well that name reservation of a new company is going to be valid for how many days, guys? Name will stay reserved for only 20 days. So name was reserved on 6th of April 2025. This plus 20 days will be 26th April 2025. By this date, the company should ensure that the incorporation process is complete. Otherwise, after this date, name reservation will lapse. Okay. Then on 15th May 2025, due to a delay in documentation, the Spice Plus form for incorporation was filed after 39 days from the date of name reservation. So come on, tell me, guys, we have filed the Spice Plus form for incorporation after 39 days. That is even beyond 20 days. After 39 days, we have filed the Spice Plus form. So by then, the name reservation would have definitely lapsed. Alright, then the question says company proposed 2 directors, 1 Indian resident, 1 foreign national residing in US. The foreign director did not have DIN. His passport was notarized but not apostilled. This information, even though it is relevant for us in the incorporation chapter, if you remember in incorporation chapter we had learned if the subscriber to the MOA happens to be a foreign national, then his documents have to be notarized and all of that. But as you read the question, you will realize that this was unnecessary information in the question. Company's registered office address was not finalized at the time of filing INC 32. MOA and AOA were signed electronically, but one subscriber used digital signature of a third party with verbal consent. Let's read the whole story and then we will see what is relevant in the question. Based on the above facts and applicable provisions of Companies Act, answer the following questions. Was the name D-Drone Private Limited still valid when INC 32 was filed on May 15, 2025? Tell me, on May 15, 2025, was the name reservation valid? The answer is no, guys. On that day, name reservation is not valid. Why? On 26th April 2025, till this date, till 20 days only the name reservation will be valid. After 26th April 2025, the name reservation will lapse. So on 15th May 2025, name reservation has already lapsed. Okay. Then comes the second question. Is it mandatory to provide the company's registered office address at the time of incorporation? This is a very, very important point. Listen to me carefully. I'll interconnect 2 to 3 concepts for you. Concept number 1. At the time of incorporation, we have to file some documents with the ROC, guys. Like for example, we have to file MOA, AOA copy with the ROC. Then we have to file a declaration saying that all the provisions of this act and the rules made thereunder relating to incorporation, everything has been complied with. We have to submit an affidavit to the ROC. So basically, when we incorporate the company, we have to submit a lot of documents to the ROC. We have to submit a lot of information to the ROC. Now, one of that information is also address. What address? Address for correspondence till RO is established. Do you remember learning this language? So if you've learned from the logic book, AP DAM, that mnemonic AP DAM we have, in that A is for address for correspondence till RO is established. So when we are getting the company incorporated, at the time of incorporation itself, we have to submit a lot of information that includes address for correspondence till RO is established. This is not the RO address. This is a temporary address till we get the registered office, till the RO is finalized. Till then, to which address all the communications will be sent, that is a temporary address that we have to give to the ROC when we incorporate the company. So are you understanding? At the time of incorporation, we don't have to give the RO address. We simply have to give a temporary address. We simply have to give an address for correspondence till RO is established. So at the time of incorporation, RO address is not required to be given to ROC. So the question over here is it mandatory to provide the company's registered office address at the time of incorporation? The answer is no. Then they're asking us, what is the time limit to furnish it otherwise? The time limit to furnish it is 30 days. We have to see what is the date of incorporation of the company. From that date, within 30 days, the verification of the RO address has to be completed by the company. So the verification of the RO address, that is, we have to inform the ROC about the registered office address only within 30 days after the date of incorporation. So two things. Question number 1, do we need to inform the ROC about the registered office at the time of incorporation? No. Then what is the time limit? When do we have to inform the ROC? Within 30 days after the date of incorporation. Okay. Then comes the third question. What are the consequences if the company fails to file the declaration for commencement of business within the prescribed time and fails to carry on any business or operation? This is nothing but a direct question on section 10A, guys. Now, what does section 10A say? Section 10A actually talks about 3 things, but here they're talking only about one thing. They're only talking about the declaration. I'll help you understand. Section 10A says that before the company can commence business, before the company can exercise borrowing powers, before that itself, the director of the company has to file with the ROC a declaration. What declaration? A declaration saying that each subscriber has fully paid for the shares of the company. Now, this declaration has to be filed with the ROC within how much time? From the date of incorporation, within 180 days, this declaration has to be filed with the ROC. Understanding? So section 10A says, before the company can commence business, before the company can exercise borrowing powers, the director of the company has to file a declaration with the ROC, a declaration saying that all the subscribers have fully paid for the shares which they have taken up, and this declaration has to be filed within 180 days of the incorporation of the company. Now listen, the ROC has a very big power over here. The ROC has a power to remove the company's name from the register of companies. See, a company will exist only till its name is there in the register of companies. But ROC has the power to remove the company's name from the register of companies if this declaration is not filed within 180 days and the ROC is satisfied that this company is not carrying on any business, company is not carrying on any operations. If both these conditions are fulfilled, then ROC has the power to remove the company's name from the register of companies. So when can ROC remove the name? What are the conditions? Condition number 1, if this declaration is not filed within 180 days and also ROC is satisfied that company has not commenced business and operations, then the ROC can simply remove the company's name from the register of companies. Okay. Then in addition to this, because you did not file the declaration on time, because the director did not file the declaration on time, there will also be a penalty. The company will also be punished and the directors and officer in default will also be punished. What is the punishment? The the company will be punished with a penalty of 50,000 rupees, and the officers in default and the directors will be punished with 1,000 rupees per day of delay, with a maximum fine of 1 lakh rupees. Getting it? So this is the entire discussion with respect to section 10A, which is being tested over here. They're asking us what are the consequences if the company does not file this declaration. There are two consequences. If the director does not file this declaration within 180 days, then consequence number 1, the ROC will be able to remove the company's name from the register, provided the ROC has a reason to believe that the company has not commenced business and operations. Then the second consequence is that the company will have to pay 50 rupees fine. The directors and officers in default will have to pay 1,000 rupees per day fine, maximum 1 lakh rupees. Alright guys, so this was our discussion on question number 3. So what were your learnings? Your learning number 1, name reservation is valid for only 20 days. After that, name reservation will lapse. Learning number 2, when the company is getting incorporated, at that time we don't have to give the registered office address to the ROC. At that time we have to give a temporary address only. Within 30 days from the date of incorporation only, we have to give the RO address to the ROC. Third learning is about the section 10A declaration. If 10A declaration is not given within 180 days after incorporation, then ROC has the power to remove the company's name from the register of companies, provided it is having a reason to believe that the company has not commenced business and operations. Okay, so this was your question number 3. Now come to question number 4. Question number 4 is a case-based scenario MCQ question from your May 26 mock test paper. Straight away come to the MCQs. We don't even have to read the story over here. When I read the MCQs itself, I will be able to answer. The first question over here. Sursangam Studios Private Limited was incorporated on 5th October 25. This is a date of incorporation. Immediately after incorporation, Aditya informed the registrar about the location of the registered office of the company. By which of the following dates must the company verify its registered office? Just now we learned whatever is the date of incorporation, from that day within 30 days we have to verify the registered office address, guys. So here the date of incorporation is 5th October 2025. From this date 30 days will be what? 30 days will be 4th November 2025. So by 4th November 2025, option B, by 4th November 2025 we have to do the verification of registered office with the ROC. Okay. Then comes the next question over here. Aditya obtained approval for the name Sursangam Studio Private Limited from the ROC on 3rd October 25. So this becomes the date of name reservation. This is the date of name reservation. By which of the following dates will such approved name remain reserved by the ROC in the first instance within which incorporation application must be filed? Name reservation will be valid for 20 days. So the name reservation was approved on 3rd October 2025. This plus 20 days will be 23rd October 2025. So only till 23rd October, that is till option C only, the name reservation will be valid. Okay. Then comes the third question. Before I start the third question, let me give you one small reminder. See, the reminder is about small company. Now, if you're somebody who is writing the exams in the May 2026 examination, then be careful. The small company limits have not been amended for you. The same old existing limits, that only will apply for you. What is the same old existing limit? The paid up share capital has to be within 4 crores and the turnover has to be within 40 crores. So that same limit will continue to apply for you. The new limit is not applicable for you. But if you're writing in September 26 exam, then the new limit will of course apply for you. Okay. So a small company means a company whose paid up share capital is not more than 4 crores and turnover is not more than 40 crores. Okay. Then we also have the list of exclusions. We have the list of excluded companies which will not be small companies. Like number 1, public companies. They will not be considered as small companies. The number 2, holding companies, subsidiary companies. Even if they fulfill this criteria, they will never be considered as small companies. Then number 3, Section 8 companies, and number 4, statutory corporations. These entities, even if they fulfill these conditions, they are excluded companies. They will not be considered as Section 8 companies. Keep this in your mind and come to the question. The question says, as several regulatory relaxations are available to small company, Aditya wishes to know whether Sursangam Studios Private Limited can be treated as a small company. See guys, if this company's name was Sursangam Studio Limited, which means if it was a public company, I won't even bother too much. I will straight away say it's a public company and public company is excluded. It cannot be a small company. But here it is a private company, which means if the private company fulfills this condition, it will become a small company, guys. So they are asking whether it can be treated as small company or not. Which of the following statements is most suitable? Option A. Since Aditya did not specifically state at the time of incorporation that the company will be a small company, Sursangam Studio Private Limited cannot be considered as a small company. No, there is no such requirement to state at the time of incorporation. This is incorrect. Then, since Aditya did not specify such categorization at the time of incorporation, Sursangam Studio Private Limited can be considered a small company only after completion of 3 financial years. There is no such provision. Only after completion of 5 financial years, no such provision. Sursangam Studios Private Limited will be considered a small company if the prescribed limits relating to paid up capital and turnover are not exceeded and the company is not covered under excluded categories. Yes, guys, option D. Option D says this company will be a small company if its paid up capital and turnover has not exceeded the limit. Yes, paid up capital has to be within 4 crores, turnover has to be within 40 crores, and also company is not excluded company. Company should not come under any of these 4. Perfectly right. Only if this limit is fulfilled and the company is not coming under the exclusions, only then it can be a small company. So my answer to the third subdivision is going to be option D. Then comes the fourth question. If Sursangam Studio Private Limited proposes to induct additional investors in the future, what is the maximum number of members it can have? It's a private company, guys. Private company can have maximum 200 members only. Easy question. Option C. Then comes the last question. If Sursangam Studios shifts its registered office within the same city, which approval is required? Guys, we are not going from one city to another city. No. We are not going from one state to another state. No. Within the same city, we are changing the RO. Within the same city, in Chennai itself, from Anna Nagar, I am going to Kodambakam. So within Chennai itself, from one area to another area, I am just shifting the RO. I don't even need shareholder approval over here. Simple board resolution only is required over here. So whose approval do I require? I only require the approval of board of directors, option C. Okay, so this was a nice case-based MCQ, but it was a very simple case-based MCQ. This was your question number 4. Now, come on guys, come to question number 5. I'm entering into the prospectus chapter now. The question is again a Jan 26 examination question. The question says, Amrit Prakash Limited was incorporated in 1996 and its registered office is in Dehradun. For expanding the business in manufacturing mobile equipment to mobile accessories also, it required capital, and for this the company issued 10 lakh equity shares of 10 rupees each at par to the public. Company is making an issue to the public by issuing prospectus, which means company is coming up with a public offer. Okay, the prospectus discloses minimum subscription amount of 50 lakh rupees. So as per the prospectus, how much minimum subscription do we need? We need 50 lakh rupees minimum subscription. You don't have to break your head about the 90% calculation and all, because the Companies Act simply says that minimum subscription is as may be prescribed in the prospectus. So in the prospectus, minimum subscription is 50 lakh rupees, which means minimum subscription is 50 lakh rupees, that's all. Then the question says the share application money shall be payable at 5 rupees per share. Now see, what does the law say? The Companies Act section 39 says that the share application money has to be at least 5% of the face value, guys. So here our face value is 10 rupees per share. So 10 rupees into 5% is going to be 0.5 rupees per share. Share application money has to be minimum 0.5 rupees per share. Here share application money is 5 rupees per share. So therefore even this is within the provisions of the act. Basically, there's no non-compliance over here. So point number 1, company is making a public offer. Point number 2, the prospectus says minimum subscription is 50 lakh rupees. Point number 3, share application money is minimum 5% of the face value. Even that condition is fulfilled. Then prospectus further reveals that Amrit Prakash Limited has applied for listing of shares in a recognized stock exchange, of which application has been rejected. This is a game changer sentence in the question. The question says, read it again. Prospectus further reveals that Amrit Prakash Limited had applied for listing of shares in a recognized stock exchange, of which the application has been rejected. So this is where your section 40 comes into the picture. Section 40 says whenever the company is making a public offer, first the company should get listing permission from all the stock exchanges. Wherever you have submitted listing application, from all the stock exchanges you have to get listing permission, then only you can make the public offer. But here in this question, what has happened? The application has been rejected, guys. So the company did not get listing permission. Because the company did not get listing permission, tell me, can the company proceed with the public offer? The company should not proceed with public offer. So however, the question says issue was fully subscribed, which means minimum subscription and all we received. Amrit Prakash received an amount of 50 lakhs on share application. 50 lakhs, guys. The minimum subscription and all we have received. Amrit Prakash proceeded for allotment. Is it okay? It is not okay. My minimum subscription has been met. My share application is minimum 5% of the face value. But section 40 has been violated over here. Section 40 clearly says if the company wants to make a public offer, first the company has to get listing permission from all the stock exchanges. Wherever the listing application is submitted, we have to get listing permission. Only then we can make the public offer. But for this company, the listing application has been rejected. So technically, the company should not make the public offer. So if the company doesn't make the public offer, there's no question, there's no requirement of allotment and all. So but however, the company has gone ahead and the company has allotted the shares, this allotment will be invalid allotment. If section 40 is violated, we call it as irregular allotment. Getting the point, guys? So company, this allotment is going to be irregular allotment. It will be invalid allotment. It will become void. Then company will have to refund the money. If the company does not refund the money on time, company will also have to pay interest. Okay, so this is a broad overview of the question, but we don't always go on the basis of the general vibe of the question. We see what exactly is the question asking us. The question is asking, examine the disclosures in the above case study, which are the deciding factors in an allotment of shares, and then they're asking us what is a consequence for violation. Two things they're asking us: examine the disclosures and then consequence for violation. So what are the disclosures over here? Disclosure number 1, minimum subscription. Yes, minimum subscription provisions have been met, perfectly fine. Then point number 2, disclosure number 2, the share application money has to be at least 5% of the face value. Yes, it is perfect. Yes, provision is fulfilled. But however, third point, the listing application was rejected. We did not get listing permission. So therefore, we cannot proceed with the public offer. We should not make the allotment. So this is where there is a violation. Now, because of this violation, they're asking us what is a consequence. There are two consequences. Consequence number 1, of course, this allotment itself will become irregular allotment. We'll have to refund the application money back. We'll also have to give interest if we don't refund it on time. In addition to that, there will also be penal obligations. The company will also have to pay fine. The officer in default also will have to pay fine, which is mentioned in section 40, because it's a section 40 violation over here. Company will have to pay fine minimum 5 lakhs and maximum 50 lakhs, and officer in default will have to pay minimum 50,000 and maximum 3 lakhs. Okay, so there is also a penal provision over here. Alright, guys, so this was our entire discussion on question number 5, which is a nice combination of section 39 and section 40. So section 39 is more or less fulfilled over here. Section 40 is only violated, because of which the allotment that the company has done will become irregular allotment, and there will also be penal obligations. Okay, then come on, guys, come to our question number 6 from a share capital chapter. Now this question is a very simple question on section 52, which is about utilization of the securities premium money. The question says MNP Tech Limited, a fast growing startup in Bangalore, recently issued equity shares at a premium of 200 rupees per share, raising a securities premium balance of 10 crores. The CFO proposes the following uses of the securities premium account to manage the company's financial commitments and investor expectations. So basically, they have given us 4 situations. We have to say in these 4 situations, can the company use the securities premium money or not? So can the company use the securities premium money to write off advertisement expenses? No. Say company can use the securities premium money to write off preliminary expenses. Company can use securities premium money to write off share issue, debenture issue expenses, but not to write off advertisement expenses. No, not allowed. Then can the company use the securities premium money to issue fully paid bonus shares? Yes, that is allowed. Section 52, guys. Then can the company use the securities premium money to provide 1.5 crore for the premium payable on redemption of preference shares? See, I want you to understand this. Let us say we have preference shares with face value of 100 rupees. When we are redeeming the preference shares, we are going to pay 110 rupees per preference shares, which means we are going to pay premium on redemption of 10 rupees. See, can I use the securities premium money to pay this entire 110? No, guys. Only to pay this premium on redemption. To pay the premium on redemption of preference shares and debentures, to pay that premium alone, yes, you can use the securities premium money. You got right clarity? To pay this entire 110, I can't use securities premium money. Only to pay the premium on redemption of preference shares and debentures, we can use securities premium account. Then comes a fourth situation, to distribute 1 crore as interim dividend. To pay interim dividend, can you use money from your securities premium account? No, that is not allowed. Okay, this was a simple section 52 question. Then come to the next question, question number 7. This is from your deposits chapter. It's a very good question testing you on the limits. The question says PRT Limited is an eligible public company. So we don't have to check whether it is an eligible company or not. They are themselves saying it's an eligible public company. Following details are available. Paid up share capital 20 crores, free reserves 8 crores, securities premium account 2 crores. Okay. Then the question says company has already accepted deposits from members 2 crores. Company has already accepted deposits from public 5 crores. Okay. Then the question says company now proposes to accept further deposits. So company has already accepted deposits from members and public. Now company wants to accept more deposit. How much more deposit? We want 3 crore from members and we want 2 crore more from the public. Okay. You are required to examine with reference to the relevant provisions of the Companies Act whether the above proposal is valid or not. So first they are asking whether it is valid or not. Then if not, calculate the maximum permissible deposits in each category. Okay, we'll go step by step. See, first of all, the question is not about eligible company. Question is about the limits. So if an eligible company wants to accept deposits from members, first of all, can an eligible company accept deposits from members? Yes, guys, every company can accept deposits from members. What's the maximum limit for eligible company? Maximum limit will be 10%. 10% of paid up share capital plus free reserves plus securities premium. So paid up share capital is 20 crores, free reserves is 8 crores and securities premium is 2 crores. So 10% of paid up share capital plus free reserves plus securities premium, that is 10% of 30 crores will be 3 crores. This is the maximum amount which they can accept from the members. But they have already accepted how much? They have already accepted 2 crores. So how much more can we accept from the members? Only 1 crore more we can accept from the members. But company wants to accept how much more from the members? 3 crores. So first they are asking, is it valid or not? No, it will be invalid because company you can accept only 1 crore more, 3 crore and all you can't accept, it will be beyond the limit. So if it is not valid, they are asking what is the maximum permissible deposits. The maximum permissible deposit will be 1 crore only. Only 1 crore more only you can accept from the members in this case. Got it? So from the members, company wants 3 crore more. Is that valid? It is invalid. Only 1 crore more only you can accept from the members. Now, similarly, we have to do the calculation for eligible company accepting deposit from the public. First of all, tell me, can an eligible company accept deposit from public? Yes, only eligible public company only can accept deposit from public. Any other company cannot accept deposit from public. What's the maximum limit for this? The maximum limit is 25% of paid up share capital plus free reserves plus securities premium. That is same 25% of 30 crores, which is going to be 7.5 crores. This is the maximum amount which the company can accept from public. But company has already accepted 5 crores from the public. So how much more we can accept from the public? Only 2.5 crore. How much does the company want to accept from the public? Company wants to accept 2 crore only, which is within the limit of 2.5 crores. So this is going to be perfectly valid. Understanding? Are you noticing? Don't generally start writing the answer. See exactly what the examiner is asking you and target exactly that. They're asking us over here whether it is valid or not. If it is not valid, then say the maximum limit. So first situation is invalid. Maximum is 1 crore only. Second situation is perfectly valid. Your maximum limit is 2.5 crores, but you are wanting to accept only 2 crores, which is within the limit, perfectly allowed. Okay, this was your question number 7. Then come on guys, come to question number 8. Question number 8 is from your charges chapter. Now, what does the question say? Let's read the question first. The question says Element Limited created a charge on one of its plant and machinery in favor of a financial institution. So the company has created a fixed charge. The company secretary was on leave when the charge was created. To avoid delay, the accounts officer of the company entered the particulars of the charge in the register of charges without any authorization of the board. This question is about register of charges. See, this is a point of confusion between a lot of students because there are actually two registers of charges, guys. There is one register which has to be maintained by the company at the registered office. There is one register which has to be maintained by the ROC. So here we're talking about the register of charges which has to be maintained by the company at the registered office. See, whenever the company creates a charge, whenever the company modifies the charge, or whenever the company satisfies the charge, immediately after that, forthwith, the language used in the law is forthwith. Forthwith, an entry has to be made into this register. So is there a time limit that within how many days you have to make an entry? There's no time limit. Immediately, forthwith, immediately the entry has to be made in the register, but this entry has to be authenticated. It has to be authenticated by whom? It has to be authenticated by a director of the company, or it has to be authenticated by a company secretary of the company, or it has to be authenticated by any other person who is authorized by the board of directors. It has to be authenticated. Clear with the provision? Now in this question, what happened? The company secretary was on leave. The accounts officer, he directly entered the particulars of charge in the register of charges without any authorization of the board. Later, a dispute arose between two creditors regarding the priority of charges. One creditor challenged the validity of the register entries, claiming that the entries were unauthorized and not duly authenticated. Yes, correct. It is not duly authenticated. It should have been authenticated by director or CS or any other person who is authorized by the board, but here it was not authenticated like that. Then they are saying, based on the company's registration of charges rules 2014, examine whether the entry made in the register of charges by the accounts officer is legally valid and what consequences may follow in case of non-authentication. Read the question carefully. I have to just answer this. They are not asking whether the charge is valid, not valid. They are not asking which creditor will get priority. The question is whether the entry is legally valid. My answer is no, the entry is not legally valid. Why is it not valid? Because it is not authenticated properly. Because of that reason, the entry is not valid. Then they're asking what consequences will follow in case of non-authentication. See, just because we did not do the authentication properly in the register, because of that reason alone, the charge will not become invalid. See, I'll help you understand, okay. If the charge has been registered, if we have registered the charge, alright, as per section 77, if we have registered the charge, then the charge is valid. Now, just because we did not authenticate the entry properly, because of that reason alone, the charge will not become invalid. The creditor will not get impacted. Come on guys, doctrine of indoor management. Doctrine of indoor management will protect the outsider, right? Here the outsider is a charge holder, the outsider is a creditor. So the doctrine of indoor management will protect the creditor, the outsider, the charge holder. He can assume that company has fulfilled all these internal rules and regulations and all properly. So the charge will not become invalid. The doctrine of indoor management will protect the creditor. Then what is the consequence? The consequence is punishment. In charges chapter, there is only one penalty. There is only one punishment section. So you can't even give an excuse over here. There's only one punishment which is given in section 86. In the entire charges chapter, whatever be the contravention, there's only one penalty. The penalty will be for the company also. The penalty will be for the officer in default also. For company, it will be 5 lakh penalty. For officer in default, it will be 50,000 rupees penalty. That's all. Getting the point, guys? So they asked us, number one, whether the entry was legally valid. No, the entry is not legally valid because it is not properly authenticated. Then they're asking what are the consequences. I am saying that point number one, the charge will not have any impact. The charge will still be valid only provided it is registered. The doctrine of indoor management will protect the outsider, will protect the creditor. So therefore the charge will not become invalid. Charge will remain valid only. Only thing is, because we have not followed this provision properly, there's a contravention of the act, and because it's a contravention, there will be penalty. Company will have to pay 5 lakh rupees, officer in default will have to pay 50,000 rupees, penalty will come into the picture. Okay, this was your question number 8. Then come to question number 9, guys, your dividends chapter. Now here we have another question from your Jan 26 examination. The question says ABC Limited, a listed company in the Indian manufacturing sector, concluded its financial year ended 31st March 25. Company is now considering declaring final dividend of 3 rupees per equity share. So we're talking about final dividend right now. With face value of 10 rupees per share. Before proceeding, the board of directors seek to ensure that the proposed dividend complies with relevant provisions of Companies Act, particularly those related to the permissible sources and conditions for dividend distribution. Then they are saying summarized financial position is given to you. What is a financial position? We have revenue from operations 10,000 lakhs, other income 1,000 lakhs. Company has incurred expenses excluding depreciation 8,000 lakhs, depreciation 1,200 lakhs. The resulting profit before tax is 1,800 lakhs. Tax provision is 450 lakhs. Finally, what is my company's net profit? The net profit after tax basically 1,350 lakhs. This is the current year profits of the company. Okay. In addition to the current year earnings, this company is having accumulated retained earnings of 2,000 lakhs. Nothing but your surplus in P&L account. Then the company is having free reserves also. Free reserves of how much? 500 lakhs. Okay. So company is having current year profit of 1,350 lakhs. Company has surplus in P&L account 2,000 lakhs and free reserves is 500 lakhs. Company has 100 lakh equity shares. Total proposed dividend is 300 lakhs. Total how much dividend does a company have to pay? 300 lakhs. So see guys, company will pay dividend out of current year profits. Current year profits is 1,350 lakhs. So current year profits are sufficient to pay the entire dividend of 300 lakhs. So because of this, we don't even have to touch our accumulated profits. We don't have to touch our reserves and all. We have enough current year profits itself. We have 1,350 lakhs. From that 300 lakhs, we can pay off as dividend perfectly fine. Now what are they asking us? Based on the above information, analyze whether ABC Limited is eligible to declare dividend under the following scenarios in compliance with Companies Act. So the question is the company eligible? Is the company eligible to declare dividend or not? Number one, out of current year profits. See, whenever the company is declaring dividend, the company will declare dividend out of what? What are the permissible sources? We have 4 sources, guys. Number 1, company can declare dividend out of current year profits after providing for depreciation and all. Then number 2, company can declare dividend out of previous year profits. Previous year profits means what? Either out of the accumulated profits, or that is surplus in P&L account, or out of free reserves and all, company can distribute dividend. Of course, after providing depreciation, after setting off losses and all. Then number 3, company can take money from both the above places. Then number 4, company can also use grants, government grants. If the company has received grant for payment of dividend, company can take money from there also. So company has 4 options. Okay. Then you would have learnt that in case the current year profits of the company happen to be absent, or in case the current year profits happen to be inadequate, in that case, the company can take money out of free reserves. And when the company does this, then you must have learnt rule 3 conditions, guys. You have 4 conditions over there, like the company, the maximum rate of dividend should not exceed last 3 years average. Then you have a 1/10 calculation, you have a 15% calculation and all. So all those conditions will come into the picture only if current year profits are absent or inadequate and companies taking money from free reserves to pay dividend, then only rule 3 conditions will come into the picture. So this is the provision. So the first question is it eligible? Can the company declare dividend out of current year profits? Company can 100% declare dividend out of current year profits. We need 300 lakhs only. We have 1350 lakhs of current year profits. So is it eligible? Can the company declare dividend out of current year profits? Definitely yes, it is eligible. Company can declare dividend out of current year profits. Now comes the second question, the question which kind of, shocked most of the students. The second question is, out of the accumulated profits of the previous year only, can this company declare dividend out of the accumulated profits of the previous year only, which means company does not want to take money out of current year profits. Company wants to take out of previous year accumulated profit only. Is that okay? That is also okay. Ma'am, how come? Because we have 4 sources. Company can take money out of any of these 4 sources. One of these sources is accumulated profits. So company can take money from here also. The only catch is, will these Rule 3 conditions apply? Rule 3 conditions will apply only if the current year profits are absent or inadequate. And because of that reason, when we take money from free reserves, then only Rule 3 conditions will apply. Tell me, is the situation applying over here? No. My current year profits are sufficient. My current year profits are adequate. Still we are taking money out of accumulated profits. For that, Rule 3 conditions will not come into the picture. Okay, so point number 1, is it eligible? Can the company take money out of current year profits? The answer is yes. Second question, is it eligible? Can the company take money out of accumulated profits also? Yes, company can take money out of accumulated profits. Even though current year profit is actually adequate, if the company wants, company can still take money out of accumulated profits because it is one of the eligible sources. But however, the Rule 3 conditions and all will not come into the picture over here, because that you will apply only if the current year profits are absent or inadequate. Okay, so this was your question number 9. Okay, now come to question number 10. This is from your management and administration chapter. So the question says, Monica Solutions Private Limited is registered as a 1% company under the Companies Act 2013. Mr. Gautam Kumar is a sole member and director of the company. Then the question says, with the financial year ending on 31st March 25, the company is preparing to comply with its annual filing and disclosure requirements. Keep in mind, it's a 1% company. Mr. Gautam Kumar is uncertain whether his company is required to hold an AGM. Tell me guys, does a 1% company have to hold an AGM? Every company has to hold AGM, but 1% company not required to hold AGM, because come on guys, one member, what meeting will he have with himself? Or there are any other alternative procedures that his company can follow. As a financial advisor, please advise Mr. Gautam on this matter. I'll tell you the entire story. See, point number 1. If my company happens to be an OPC, then first of all, AGM is not required. Any general meeting is not required for that matter. Then in this company, how will shareholder resolutions be passed? In some matters, ordinary resolution has to be passed. In some matters, special resolution has to be passed. So if meeting itself is not being held, then how will these resolutions be passed? For that, we have an alternative procedure. What is the alternative procedure? If you look at the logic book, last page of management and administration, you will find this, guys. See, I'll give you a reminder. If the matter is such where ordinary resolution or special resolution is required, then step number 1, that one member of the company, he will communicate his decision to the company. Basically, he will communicate his resolution to the company. Then entry of his decision, entry of this resolution will be made in the minutes book. Okay, then this entry has to be signed and it has to be dated by that one particular member that we have. Then lastly, whatever date is mentioned in the minute book, that date will be deemed to be date of the general meeting. Why are we using the word deemed? Because in reality, any general meeting has not happened over here. We will just assume whatever date is put in the minutes book, we will assume on that date general meeting was held, and on that date that this resolution was passed, like that we will assume. Understood? So in a 1% company, first of all, no requirement of general meetings. So whenever any matter for which resolution has to be passed, so in those matters, how will the resolution be passed? Very simple. The member, we have only one member in 1% company, right? That one member will make a decision that what resolution he wants to pass. He will communicate his decision to the company. Company will make the entry in the minutes book. Then this member will sign that entry and he'll put the date. Whatever date is put in the minutes book, that will be deemed to be the date of the general meeting. Similarly, there are some matters for which board resolution has to be passed. Now see, 1% company has minimum one director. It can have more than one director also. If it has more than one directors, if it has multiple directors, then board meeting meeting will be held. In that board meeting, board resolution will be passed. But what if in this 1% company, there is only one director? It is only one director. Again, same thing. Board meetings and all will not be held then, because only one director. What meeting he will have with himself? So in such cases, how will the board resolution be passed? Same thing, that one director, he will communicate to the company what resolution he wants to pass. He will communicate it to the company. The company will accordingly make an entry in the minutes book, and this director will sign this entry, and he will put a date for this entry, and this date will become deemed to be the date of the board meeting. So same thing. Okay, so this is exactly what they're asking in this question. They're asking, first of all, is AGM required? No, AGM is not required. Then they're asking, what are the alternative procedures? These are the alternative procedures. For ordinary resolution and special resolution, the member will communicate his decision to the company. If it is board resolution, if we have multiple directors, then we will have usual board meeting. But if we have only one director, same thing, that one director will communicate his resolution to the company. Entry will be made in the minutes book. Entry will be signed and dated by that one particular director, and then whatever date is put in the minutes book, that will become the deemed to be date of the board meeting. Okay, this was your question number 10. Then come to question number 11. Question number 11 is difference between motion and resolution. It's simple. See, understand the sequence. First, the motion is put before the members, and then only resolution is passed. Like for example, let's take an example. Let's say company wants to issue sweat equity shares. So this proposal that let's issue sweat equity shares, this proposal is called as motion. Then for this motion, the shareholders will start voting. So if the shareholders, if we get majority vote, like if it is ordinary resolution, if we get majority vote, or if it is special resolution, we need 3/4 majority. So if we get these votes, then we say that the resolution is passed. So that proposal that let's issue sweat equity shares, that proposal is called as motion, and then that motion is followed by a resolution. The resolution is nothing but the decision of the shareholders. The resolution will indicate the will of the members. If the members want to, if the members are okay with the motion, they will pass the resolution. If the members are not okay with the motion, the resolution will not be passed. Okay, so the sequence should be clear. First the motion comes, and then the resolution comes. Motion is nothing but the proposal. Resolution is nothing but the decision which is made by the shareholders for that proposal. Okay, then come to question number 12. Question number 12 is another interesting question from your Jan 26 examination. The question says, Saras Ventures Limited, a public limited company incorporated under the Companies Act 2013, has a board comprising of 7 directors. So the company's board of directors is having 7 directors. A group of shareholders holding 1.2% of the total voting power has expressed dissatisfaction with one of the directors, Mr. Ankur Chabra, and has proposed his removal under section 169. Don't worry, this question is not about removal of directors. Removal of directors as such is not in the syllabus. This question is from section 115, which is resolution requiring special notice. So don't worry. So here we have members who are holding 1.2% of the total voting power. They want to remove the director. Now the company's AGM is scheduled for 25th August 25. On 1st August 25, the company received the special notice under section 115 proposing an ordinary resolution for the removal of Mr. Ankur Chabra at the upcoming AGM. However, the company subsequently failed to notify the members of the special notice. The company failed to notify the members of the special notice. With reference to the applicable provisions of the Companies Act, examine the validity of the special notice. So the first thing that they are asking is the validity of the special notice. Then they are asking us what are the consequences of failure to notify the members about the special notice. There are 2 questions. We'll go step by step. Point number 1. Special notice has to be given by whom? It has to be given by the members. How many members? Members put together who are holding at least 1% of the total voting power, or the members should be holding at least rupees 5 lakhs paid up share capital. Here the question doesn't talk about paid up share capital. Even I will not talk about paid up share capital. Tell me, do the members hold at least 1% of total voting power? Yes guys, members are holding 1.2% of total voting power. So this condition is fulfilled. Members holding at least 1% of the total voting power. power have submitted special notice to the company. Point number 1. Then comes point number 2. What is a time limit? When should the special notice be submitted to the company? We have a time limit, guys. See, we'll have to see what is the date of the general meeting. When is a meeting going to be held? Before that, we will see 3 months. In these 3 months only, the special notice has to be given to the company. So, can the members deposit the special notice with the company even before the 3 months period? No, it will not be valid. During the 3 months before the general meeting, in those 3 months only, the notice has to be given to the company. Okay. But however, last minute notice should not be given, which means before the meeting, leave 14 days, leave 14 clear days. In these 14 days, just before the meeting, in the last 14 days, the special notice should not be given to the company. So listen then, I'll give you the final conclusion. So finally, when should the special notice be given to the company? It should be given during the 3 months before the meeting, but not in the last 14 days. So in simple words, it has to be given in this period. Can I give the special notice to the company during these 14 days? No, there has to be clear 14 days gap. Okay guys, now in this question, see, when is the meeting going to be held? The meeting is going to be held on 25th August 2025. And when was the notice given? Notice was given on 1st August 2025. Yes, it is given during 3 months before the meeting. Yes, it is given before 14 days. Is it given during the last 14 days? No, before the last 14 days itself, we have given the notice. There is minimum 14 days gap. There is minimum gap between these two dates. So therefore, the time limit is also fulfilled over here. So the special notice has been given by members holding at least 1% of total voting power. Also, the special notice has been given within the prescribed time limit. It is given during the 3 months before the meeting, but before 14 days, not in the last 14 days. It's given even before the 14 days period can start. Therefore, the time limit also has been fulfilled. So the first question was, examine the validity of the special notice. Yes, the special notice is perfectly valid. Okay. Now listen, there is one more provision. The provision goes like this. Once the company receives a special notice, the company has to notify all the members about the special notice. The company has to give a 7 clear days notice to all the members, telling the members that like this, we have received a special notice. Okay, but sometimes it is not practical that just in the last 7 days alone giving this notice may not be practical. So if it is not practical, we do have one option for the company. Company C, either give the 7 clear days notice to each and every member, or what you can do is you can simply give one advertisement in one English newspaper, one vernacular newspaper which is having wide circulation in the state where the RO is situated. Give an advertisement over there and also put about this special notice in your website. So the company has an obligation to inform the members about the special notice when at least 7 clear days before the meeting. Company is supposed to inform the members either through the notice or through the advertisement. But here what does the question say? Here the question says company failed to notify the members. So the question is asking us, what are the consequences of failure to notify the members? See, if the company does not notify the members, then what will happen? The special notice will not become invalid. The special notice is valid, we have already concluded. But now, in the meeting, if any resolution is passed relating to the special notice, if any resolution is passed relating to removal of directors, in this case, that resolution will become invalid. Understanding? So the company is supposed to notify the member 7 days before at least 7 clear days before the meeting. If the company does not notify the members, then in that case, in the meeting now, if any resolution is passed relating to removal of directors, in this case, that resolution will become invalid. Okay guys, so this was the question 12 on section 115, resolution requiring special notice. Then come to our next question, question number 13, which is from your accounts of companies chapter. This question is about authentication of financial statements. Who has to sign the financial statements? Let's talk about this. It's very simple. See, the financials of the company have to be signed by the chairperson if he is authorized by the board of directors. If he is not so authorized by the board of directors, then it has to be signed by 2 directors, out of which one of them has to be a managing director. Okay, so the first box, either it will be signed by the chairperson if authorized by the board. If not authorized, will be signed by 2 directors, out of which one will be managing director. Then in addition to this, the financials also have to be signed by the CEO of the company, then the CFO of the company, and then the company secretary of the company. So totally how many boxes will you have over here? Totally 4 boxes you will have. Okay, but however, if it's a 1% company, here one single director will have to sign the financial statements. Alright, now come to the question. The question says Board of Directors of XYZ Petrochemicals Limited consists of Mr. R, Managing Director. Then we have Mr. N and Mr. P, Director. So Mr. R is a Managing Director. Then N and P are directors. Then we have Mr. A, who's a chairperson. Then we have Mr. D, who's a chief financial officer. He's a CFO of the company. And then we have Mr. C, who's a company secretary. So they've given us information about 5 sets of people. The board of directors as a policy does not authorize the chairperson to sign the financial statements. So the chairperson is not authorized over here. So in this question, 2 directors, out of which one is managing director, CEO, CFO, CS, these are the persons who will have to verify. So if I have to give names, they haven't spoken about CEO. The CS is Mr. C. The CFO is Mr. D. There's no CEO in the company as per the question. Then the 2 directors, out of which one has to be managing director. So Mr. R has to verify. Along with Mr. R, totally 2 directors, right? One of them is managing director. So R is a managing director. Now one more director, either N or P, any one of them. So these are the people who have to authenticate the financials in this question. The question says a P&L account of and balance sheet of the company were signed by N, P and A. N, P and A. Is this correct? No, right? Even D has to verify, even D has to authenticate, even C has to authenticate, even R has to authenticate. Only N, P and A, this will be definitely wrong. In fact, A is a chairperson of the company. Chairperson is not even authorized by the board. So chairperson is not even supposed to authenticate over here. So what the company has done over here is definitely in contravention of the provisions of the Companies Act. So examine whether the authentication of the financial statements was in accordance with the provisions of Companies Act. No, it is not in accordance with the provisions of Companies Act. As per the Companies Act, in this question, 2 directors, one of which is managing director, CEO, CFO and CS, these are the 4 people who have to verify. Here it's definitely not as per the Companies Act. Then they're asking what would be your answer in case the company is a 1% company and has only one director who has authenticated the balance sheet and statement of P&L account. Then it will be perfectly valid, because in 1% company, one director's authentication only be required. Okay, so this was question number 13, targeting authentication, that is signing of the financials. Alright, then come on guys, come to the next question, question number 14. This question is purely about XBRL. See, we know that every company has to file financial statements with ROC. Now some companies have to file in XBRL taxonomy, right? This question is about that. See, first of all, tell me which companies have to do the filing in XBRL taxonomy. Number 1, all listed companies. The filing has to be in XBRL taxonomy only. Then their Indian subsidiaries. So listed companies and their Indian subsidiaries. Then number 3, all those companies, whether listed, unlisted, doesn't matter, whose paid up share capital is at least 5 crores. Then all those companies whose turnover is at least 100 crores. Then all those companies whose financial statements have to be as per Ind AS. So these companies, it is mandatory that they have to do the filing of financials with the ROC in XBRL taxonomy only. Okay. Now with this much knowledge, come on, let's have a look at the question. Let's see what the question says. RMP Private Limited is an unlisted company. It's an unlisted company, guys. So it's not coming under the first bucket. Then it has paid up share capital of 6 crores. So paid up share capital 6 crores. It is definitely at least 5 crores. So the company is coming under this bucket. Then turnover is 90 crores. So turnover is not more than 100 crores. So the company is not coming under the 4th bucket. Then company is not required to prepare financials as per Ind AS. So the company is not coming under the 5th bucket also. But it's okay, any one bucket. Yes, company is coming under the 3rd bucket. So therefore for this company, the financials have to be filed using XBRL taxonomy only. But what did this company do? The company filed its financial statements for 24-25 in AOC 4 instead of AOC XBRL. This is invalid. Company, for you XBRL taxonomy is applicable. You are a company with paid up share capital at least 5 crore. You have to file the financials with ROC using XBRL taxonomy only. You did not file using XBRL, so therefore it's going to be invalid filing. State the classes of companies required to file financials. So first they're asking us for the list of companies. This list we have to give. Then they are saying examine whether RMP Private Limited has complied with the legal provisions. No, it has not complied. So read the question, see exactly what they're asking. They're asking two things. First, they're asking you to state the classes of companies which have to file financials using XBRL. Then they're asking you whether the company has complied with the applicable legal provisions. No, company has not complied with the legal provisions. XBRL is applicable for the company, but the company has not filed in XBRL taxonomy. So therefore, company has clearly contravened the provisions. This was question number 14. Now come to question number 15, guys. Companies incorporated outside India. So here we have a couple of questions, some good questions. Look at them. The first question over here is from a Jan 26 question paper. The question says Zentech Limited, a company incorporated in Singapore. So the company is incorporated outside India. It has a branch office in Bangalore. The financial year of the company ends on 31st March 25. As per the provisions of Companies Act, Zentech Limited is required to file certain documents with the ROC every year. However, due to internal audit delays in its Singapore headquarters, the company could not finalize its financial statements by September 2025. The management seeks clarification on the following points. Number 1, what documents need to be filed by Zentech Limited along with financials with the ROC? Let's talk about this. See, if we have a foreign company, the foreign company is supposed to file with ROC New Delhi. Not ROC CRC, ROC New Delhi. We have to file with ROC New Delhi the financial statements to the extent of the Indian business operations. Those financials have to be filed with ROC. Along with these financials, some more documents also have to be filed. Like we also have to file a statement on repatriation of profits. We also have to file a statement on a related party transactions. Then we also have to file a statement on transfer of funds, like transfer of dividends and all. So these documents also have to be filed with ROC. That's the first question over here. What documents have to be filed by Zentech Limited along with financials with ROC? These documents. Then they are asking us by what time should these documents be normally filed? Even this is very simple. We have to see the end of the financial year. From the end of the financial year, within 6 months, we are supposed to do this filing. So here the end of the financial year is 31st March 25. 6 months will be 30th September 25. By this date, we should file these documents with the ROC. In case we are not able to file within this much time, then we can ask for an extension from the ROC. ROC will give us another 3 months extension, which means the extended time limit will become 31st December 25 in this case. Okay, so normally we are supposed to file within 6 months from the end of the financial year, but in case we are not able to file within the normal time limit, we can ask for 3 months extension from ROC. Okay, this was your question number 15. Now come to question number 16. It's an MCQ from your mock test paper, May 2026 mock test paper. The question says Q Limited, a company incorporated outside India, entered into a contract with L Limited, incorporated in India, for supply of machinery. So this company, which is incorporated outside India, has entered into a contract. However, Q Limited, that is this company incorporated outside India, failed to comply with the provisions of Chapter 22 of Companies Act relating to foreign companies. Now listen to me. So if the company is incorporated outside India, this company has to comply with Chapter 22 of the Companies Act, guys. So if this company does not comply with this chapter, that is if the company contravenes any applicable provision of the Companies Act, then in that case, whatever contracts this company has entered into, contracts, nothing will happen. They will continue to remain valid. Other parties can sue this company, even that there's no problem. But however, this company incorporated outside India, which has contravened the provisions, this company will not be able to sue other parties. This company will not be able to take legal action against other parties. Understanding? So over here, this company has not complied with some provisions. So the contract will still remain valid. Other parties can still take legal action against the company, but this company cannot take legal action against others. So in this context, which of the following statements is correct? The contract between Q Limited and L Limited becomes void. No, the contract will not remain, the contract will remain valid only. It will not become void. Then the contract remains valid. Q Limited cannot initiate legal proceedings. Yes, option B. Contract remains valid. Others can initiate legal proceedings against us, but we cannot initiate legal proceedings against others. So option B. Okay. This was your question number 16. Now I'm coming to your LLP Act question number 17. Now this question, similar question was there in Jan 26 question paper also and in the May 26 RTP also. So the question says, Bright Consultants LLP is facing temporary financial difficulties and proposes a compromise with unsecured creditors. So we're talking about compromise or arrangement, guys, the last concept in our LLP chapter. The compromise with unsecured creditors. Compromise can either be with partners or it can be with creditors. Here it is with creditors for payment of 70% of the outstanding dues in full settlement. Then the question says, an application is made before the tribunal by one of the partners. Is it okay? See, whenever there's a compromise, an application has to be made. To whom? To NCLT. Here application is made to the tribunal, correct only. Then this application has to be made by whom? Either by the LLP or by the creditors or by the partners, or if the LLP is in the liquidation process, then the application will be made by the liquidator. Here the application is made by the partners. Even this is proper. So till here everything is fine. The tribunal orders the meeting to be held. At the meeting, creditors representing 75% in value of the total outstanding debt vote in favor of the proposed compromise. So in the meeting of the creditors, which is ordered by NCLT, in that meeting, we need consent of the majority of the creditors who are holding at least 3/4 in value of the debts. Here if you see, we got consent from creditors holding 75% in value. So we got consent from creditors holding 3/4 in value of the debts, but we'll assume that they also constitute majority of the creditors, we'll assume. Okay. LLP thereafter approaches a tribunal for sanction of the scheme. However, the LLP fails to disclose in the application that an investigation proceeding is pending against it under the LLP Act. Now about this we have to talk. See, listen carefully. Whenever we make an application for compromise, in this application we have to mention two things. Number one, we have to mention the latest financial position of the LLP, and number two, we also have to mention any pending investigations. Are there any pending investigations against the LLP? Even this has to be mentioned. But here they are saying in the application, we did not mention an investigation proceeding which is pending against the LLP under the LLP Act. LLP failed to disclose it. So because in the application, we have not mentioned the pending investigation proceedings, the NCLT will not sanction the compromise. Okay. So then the question says, after obtaining tribunal sanction order, LLP does not file the order with registrar within 30 days. This is one more problem, guys. So the provision goes like this. Once the NCLT passes an order sanctioning the compromise, now this order has to be filed with ROC within 30 days. Only if it is filed with ROC within 30 days, only then the NCLT's order will be effective. But here the question says LLP does not file the order with the registrar within 30 days. Then dissenting creditor challenges the validity. What are they asking us? Two things. Thing number one, whether the compromise can be sanctioned by NCLT despite non-disclosure of pending investigation proceedings. This we discussed that no, if the pending investigation proceedings are not disclosed, then no, NCLT will not sanction the compromise. That is what they are asking. Whether compromise will be sanctioned by the NCLT, no, NCLT will not sanction the compromise. Then they are asking whether the compromise becomes effective and binding if tribunal's order is not filed with ROC. No, the tribunal's order will become effective only after we file a copy of NCLT's order with ROC, then only it becomes effective. So if we don't file it with ROC, then no, it will not be effective, it will not be binding. Okay, so this entire question was testing us on two things. Thing number one, that whenever we file an application with the NCLT for compromise or arrangement, then in the application we have to mention two things. Number one, the financial position of the LLP, and number two, the pending investigation proceedings. Okay, then number two, one more thing we learned, that in case the NCLT passes an order sanctioning the compromise or arrangement, then a copy of the order has to be filed with the ROC within 30 days of the NCLT's order. Only then it will be effective and binding. Okay, this was a question number 17. Now come to question number 18. One more question on LLP Act. MNO LLP is under scrutiny by the registrar for certain irregularities in its financial disclosures. Registrar sends a written notice to Miss A, former designated partner of MNO LLP, asking her to provide specific details and explanations regarding certain transactions within 15 days. Let me help you understand the provision first. I'll remind you of the provision. So we have a provision in the LLP Act which says that ROC can ask for information from the partners of the LLP, from the designated partners of the LLP, from the former partners of the LLP, or from the employees of the LLP. From any of them, ROC can ask for information. ROC can ask for answers to ROC's questions. Then ROC can ask for a declaration from these people. ROC can also ask them to supply details or to supply particulars, whatever ROC requires. So if ROC asks this information from these people have to provide the information to the ROC within prescribed time. Okay, so here the question says that this ROC has sent a notice to Miss A, who is a former designated partner. Yes, we can ask information from former partners also. So ROC has asked this former partner to give information within 15 days. But Miss A fails to furnish this information within the stipulated time. So if this person does not provide information within the prescribed time, or they provide information but that information is not satisfactory for the ROC, then in that case ROC can issue a summon to this person. Summon means what? Summon means ROC can formally call this person to be present in front of the ROC, in front of the inspector or any other public officer. So ROC can ask this person to come in front of these people and then make the declaration or then supply the particulars or then answer the question. So this is exactly what has happened over here. Miss A fails to furnish the information within the stipulated time. Thereafter she submits an incomplete reply which registrar finds unsatisfactory. So as per the provisions of LLP Act discussed, question number 1, whether the registrar is empowered to seek information from Miss A despite her being a former designated partner, your answer is yes. ROC has the right, ROC has the power to ask information from partners, designated partners, former partners or employees. ROC can ask information from any of them. Yes, ROC can ask information from former partner Miss A also. Then they're asking us, what further actions the registrar can take when information is not provided within the given time or if it is unsatisfactory. Then in that case, ROC will issue a summon. ROC will ask this person to be present in front of the ROC inspector or public officer, as the case may be, to come in front of these people and then answer the question or then give the declaration and then supply the particulars. Okay, this is your question number 18. The whole point over here, the whole focus over here is that can we ask information from former partner also? The answer is yes. Okay, then come to question number 19. This is a question from your Jan 26 question paper. The question says, Amit and Priya are partners in XYZ LLP, a consulting firm. Recently, Priya moved to a new address but forgot to notify the LLP within the required period. This is wrong, guys. There's a provision in your LLP Act which says that if any partner's address or any partner's name undergoes a change, then the partner has to inform the LLP within 15 days of the change. Then LLP will inform the ROC within 30 days of the change. So the partner has to inform the LLP first about the change in name or about the change in address. Then LLP will inform the ROC. But here the question says Priya moved to a new address but forgot to notify the LLP. She did not inform the LLP. Then a month later, Amit's cousin Ramesh expressed interest in joining the LLP as a partner. So new partner is joining the LLP. Whenever a new partner joins the LLP, again LLP has to inform ROC about the particulars of this new partner along with written consent of this new partner. LLP has to give it to the ROC within 30 days of appointment of the new partner. Okay, so here once again Amit and Priya are partners. Priya moved her address but she forgot to inform the LLP. Then Amit's cousin Ramesh expressed interest in joining LLP as a partner, and after a few discussions, he was accepted as a new partner. However, XYZ LLP did not immediately update ROC regarding Priya's address change or Ramesh's admission as a partner. So there are two problems over here. About the address change also we have not informed ROC. About the new partner's admission also we have not informed ROC. Then the question says, after 45 days of joining After 45 days of joining Mr. Ramesh, LLP filed a notice with ROC about these changes. Definitely ROC has done the filing really late, because time limit is 30 days. LLP is informing ROC only after 45 days. There's definitely a delay. Advise the LLP about the default on part of the LLP about non-compliance in respect of not informing ROC about whether Ms. Priya contravened any provision regarding address change. Yes, Ms. Priya has contravened. She was supposed to inform the LLP about the change within 15 days of the change. Only then LLP can inform ROC about this within 30 days of the change. So she did not inform the LLP. Definitely she has done a contravention. Then default on non-compliance in Mr. Ramesh's admission as a partner. Here also there's a default. When Mr. Ramesh was admitted as a partner, within 30 days of his appointment as a partner, LLP should have informed ROC about his appointment. LLP should have given to the ROC the particulars of the new partner along with his written consent, but LLP did not do it within 30 days. LLP did it only after 45 days, which is definitely a delay. And please know, in this default, the LLP, the designated partner, then in our first case, Ms. Priya, who did not inform the LLP about her address change, all of these people will be punished with 10,000 rupees fine. Okay, so this was our entire discussion about giving a notice to the ROC. So we have to give a notice to ROC whenever a new partner is admitted. We have to inform the ROC within 30 days. Also, when there's a change in the partner's name or when there's a change in the partner's address, then also the partner has to inform the LLP about it within 15 days of the change, and LLP has to inform ROC within 30 days of the change. If there's any non-compliance over here, the LLP, the designated partner, then this partner who has not informed the LLP about the change, all of these will be punished with 10,000 rupees penalty. Okay, this was question number 19. Now come to question number 20. It's a case-based MCQ on LLP Act. Let's read the question first. APC Solutions LLP, registered under the LLP Act, operates a software consultancy firm based in Punjab with two partners. So there are only two partners, Mr. X, designated partner, and Mr. Y, only two partners. LLP agreement requires 30 days notice for resignation, but Mr. Y skips notice to Mr. X and the firm and unilaterally files Form 6 with ROC. So in this LLP, there are two partners. One of the partners, Mr. Y, he is resigning, but he is not giving any notice to the other partner. He is not giving a notice to LLP. He is directly informing the ROC. Okay. Then LLP fails to file mandatory Form 4 with ROC within the prescribed time, attracting a penalty of 100 rupees per day for designated partner. By the way, we had two partners, X and Y. So Y has resigned. Now we're left with only one partner. Keep that in mind. Then Mr. X, having knowledge of Mr. Y's cessation since Jan 26, continues to run the business as a sole remaining partner. Is it okay? See, when we're left with only one partner, we will give this LLP 6 months time to bring the number of partners back to 2. If they're able to do it, great. But if 6 months have lapsed and still if we have only one partner, then this one single partner will have to face a consequence. This one single partner will now become personally liable. He will have unlimited liability for the LLP's debts. Which debts of the LLP? Those debts which are contracted after the 6 months period. For those debts, Mr. X will become personally liable. But this consequence will apply only if Mr. X is aware of the fact that for more than 6 months, the LLP has continued with just him as a partner. Mr. X has to be aware of this fact. That is what they're saying over here. Mr. X has knowledge. He is aware of the fact. He has knowledge that Y ceased to be a partner since Jan 26. He continues to run the business as the sole remaining partner. He enters into new client contracts and incurs supplier debts amounting to 50 lakhs over the next 8 months. So he is continuing in the LLP. It has been more than 6 months. He is still continuing in the LLP. He is incurring 50 lakhs debt. For this 50 lakhs debt, he will become personally liable. Why? Because for more than 6 months, it's been 8 months. It's been more than 6 months, but LLP is continuing with just one single partner. Now for this 50 lakh debt of the LLP, for that Mr. X will become personally liable. Now see what is the question saying. They're asking the first question over here. Under the LLP Act 2008, what is a general consequence when an LLP is reduced to only one partner because the other partner leaves and no new partner is admitted? So what is general consequence when we have only one partner? Then in that case, you will give the LLP 6 months time to bring one more partner. If they don't, then the existing partner will become personally liable. So LLP and the remaining partner may continue temporarily, but the remaining partner will become personally liable if the new partner is not admitted within the statutory period. Within 6 months, if the new partner is not admitted, then the existing partner will become personally liable. Yes guys, option A. Then, if the LLP continues business with only one partner beyond the statutory grace period, what is the statutory grace period? 6 months, right? So, if the LLP continues with only one partner beyond 6 months without admitting a new partner, what is the nature of the remaining partner's liability for obligations incurred during the default period? The remaining partner's liability will become personal liability, unlimited liability. So, remaining partner continues to enjoy limited liability? No. Remaining partner will now become personally liable for LLP's obligations. Remaining partner may be held personally liable similar to a partner in a traditional unlimited partnership for obligations incurred during the non-compliant period. Option B. This particular partner will become personally liable. Then comes the third question. Assume Mr. Y has resigned from ABC Solutions LLP and his cessation has been duly filed and recorded. See, you know something, when a person ceases to be a partner, okay, about his cessation, about the fact that he's left the LLP has to inform the ROC. We have to file about his cessation with ROC, only then it is going to be effective. So here the question is saying that his cessation has been filed with ROC. So Mr. Y resigned and his cessation has been duly filed, which means his cessation is now going to be effective, guys. A creditor supplies goods 2 months later. So Mr. Y resigned, his cessation is effective. 2 months after that, a creditor supplied goods. For that, will Mr. Y be liable? No, right. This transaction is happening after Mr. Y's cessation. Mr. Y has ceased to be in the LLP. His cessation is also effective. We have informed ROC about it. It has been duly filed with ROC. His cessation is effective. Now, after this, whatever happens in the LLP, he will not be liable. So, the question says, a creditor supplies goods 2 months later, relying on old stationery, still showing Mr. Y as partner. What is the most likely legal position of Mr. Y? Mr. Y has no liability because he validly ceased to be a partner and proper notice was given. Option A. Once the cessation is effective, after that, whatever happens in the LLP, the partner will not be liable. Then, can suppliers proceed against Mr. X's personal property for recovery of 50 lakhs? This we already discussed. For this 50 lakh, Mr. X will become personally liable. So, can the suppliers proceed against Mr. X's personal property? Yes, he is personally liable. Mr. X is liable, so we can proceed against his personal property. Alright, so this was your question number 20, a case-based MCQ on LLP Act. Now come on guys, let's enter into our FEMA discussion. Come to question number 21. Now question number 21 is about residential status of non-individuals. See, if a company is incorporated in India, okay, then that company will become PRI. Then if we have a branch or an office or an agency in India, then again this branch, office, agency will become PRI. Then if we have a branch or an office or an agency which is outside India, but however this branch happens to be controlled by a PRI, even though it is outside India, if it is controlled by PRI, then this branch office agency will become PRI. So when does a non-individual become PRI? Either it should be incorporated in India, or it should be a branch office agency which is in India, or if the branch office agency is outside India, then that branch office agency should be controlled by PRI. In these cases, that non-individual will become PRI. Keep this in mind and look at the question. The question says, Golden Global Limited is a company incorporated and registered in Germany. It's a company incorporated outside India. It is not incorporated in India. So therefore, Golden Global Limited will become PROI. Only if it is incorporated in India, it will become PRI. But here it is incorporated in Germany, this will become PROI. Then on 1st April 2012, it established a branch office in Chennai. So this branch office is in Chennai, branch office is in India. So this branch will become PRI. Then the Chennai branch subsequently began controlling operations of another branch in Dubai. So the branch is in Dubai, but it is controlled by the Chennai branch, which is a PRI. So the branch in Dubai is controlled by PRI. So this branch in Dubai will also become PRI. Understanding, the company is not incorporated in India. So the company is PROI. The Golden Global Limited is PROI. Then Chennai branch, the branch is in India. So the branch will become PRI. Then Dubai branch, the branch is outside India, but it is controlled by Chennai branch, which is a PRI. So the Dubai branch is outside India, but controlled by PRI. So the Dubai branch also becomes PRI. Okay, so this was just about the residential status of non-individuals. Then come to question number 22. Question number 22 is about current account transactions. Let me give you the reminder of the provision first. So we have these foreign exchange management current account transactions rules 2000, guys. Now in these rules you have 3 schedules. You have schedule 1, schedule 2 and schedule 3. Right now I'm talking about schedule 1. Schedule 1 has the list of prohibited transactions. These are those transactions for which drawal of foreign exchange is prohibited. So in these transactions, one of the transactions is drawal of foreign exchange to pay commission under rupee state credit route. Any drawal of foreign exchange to pay commission under rupee state credit route is a prohibited transaction. It is not allowed, guys. But there's an exception. If you remember, we had learned that if the commission happens to be within 10% of the invoice value, and if the goods that are being exported happens to be tea or tobacco, then drawal of foreign exchange is going to be permitted. Remember? So generally, any drawal of foreign exchange to pay commission under rupee state credit route is prohibited. But however, if we are drawing foreign exchange to pay commission under rupee state credit route, but if it is within 10% of the invoice value and the goods are tea and tobacco, then it will be permitted. You can take foreign exchange for that. You can draw foreign exchange for that. It will be permitted. Okay. Keep this in your mind and come to the question. ABC Exports Limited, an Indian exporter, entered into an agreement to export machinery to a foreign buyer under rupee state credit route. What are we exporting? What are the goods here? Machinery. As per the agreement, the company proposed to pay commission to overseas agent 8% of the invoice value for facilitating export. Will this be allowed, guys? Commission, any commission if you're going to pay, for which if you need foreign exchange, if it is under rupee state credit route, it is not permitted. It is a prohibited transaction. So this is definitely going to be a prohibited current account transaction, a prohibited transaction under schedule 1. Then the question says, in another transaction, the company exported tea or tobacco under the same route and paid commission 12% of invoice value. Even this will become a prohibited current account transaction. Why? If the commission under rupee state credit route is for tea or tobacco, it is a permitted transaction, but the commission has to be within 10% of the invoice value. Here commission is 12% of the invoice value, more than 10% of the invoice value. So even this will become a prohibited current account transaction. Both will become prohibited current account transactions. Getting the point? So the first transaction is prohibited because commission under rupee state credit route, drawal of foreign exchange for this is anyways prohibited. Second will also become a prohibited current account transaction because yes, no doubt the goods are tea and tobacco, but the commission is more than 10% of the invoice value. So even here it will become a prohibited current account transaction, prohibited under schedule 1. Okay. Then come to question number 23. This is from your Jan 26 question paper. The question says Skynex Limited, incorporated in India in 2024, is engaged in the manufacture of lithium batteries for two-wheeler. Company markets its products domestically and exports to Mexico. During the financial year 25, company engaged in the following transaction. Commission paid to an agent in Mexico for the sale of company's commercial plot in India to the tune of $50,000 against inward remittance of $950,000 from exchange earner's foreign currency account. What has happened over here? First of all, we have a company. This company has paid commission. How much commission? They have paid 50,000 commission. This commission is relating to what? Sale of commercial plot in India. This commission is paid to agent in Mexico for sale of a plot in India. Against this sale of plot, there's inward remittance of $950,000. This commission is paid from exchange earners foreign currency account. For a moment, ignore the question and listen to the whole provision first. See, first of all, this is a current account transaction. We have the foreign exchange management current account transactions rules. This transaction is covered in Schedule 3. Schedule 3 consists of those transactions which are permitted. For these transactions, you can draw foreign exchange but with RBI approval. So this transaction over here is a Schedule 3 transaction, a transaction which requires RBI approval. So I'll explain the provision to you first. So here on one side, we have a non-individual. Okay, this non-individual is making payment of commission. To whom? To the agent abroad. Now, what is this commission for? This commission is for sale of what? Sale of either residential flats or sale of commercial plots. And where are these residential flats or commercial plots? They are in India. Okay, so if a non-individual is paying commission to agent abroad for sale of residential flats or commercial plots in India, for this commission, if you want to draw foreign exchange, if that foreign exchange happens to be more than the limit, then in that case, you will require RBI approval, guys. Now comes the question, what is the limit? The limit depends upon the inward remittance. We will see what is the inward remittance. 5% of the inward remittance or $25,000, whichever is higher, this will be the maximum limit. So if we are paying commission to an agent abroad for sale of residential flats or commercial plots in India, and for payment of this commission, if you are drawing foreign exchange, which is more than this limit, then we require RBI approval. What is the limit? 5% of the inward remittance or $25,000, whichever is higher. Now come to the question, what is the inward remittance over here? See, the inward remittance is $950,000. So $950,000 into 5% will be how much? That will be 47,500. So 47,500 or $25,000, whichever is higher. Which is higher? 47,500. So here the limit is 47,500. Now how much commission is your person paying? The Skynex Limited is paying $50,000 commission. So our commission $50,000 happens to be more than $47,500. So if I stop over here, I will say that okay, the commission is more than the limit. So therefore, RBI approval is required, guys. But please note, there's one more provision which says that if this remittance of commission is happening out of the exchange earner's foreign currency account, any transaction in Schedule 2 or in Schedule 3, if the transaction is happening out of exchange earner's foreign currency account, then in that case, approvals and all are not required. Okay. But however, there's an exception, and the exception is this commission. This commission, even if the transaction is happening out of exchange earner's foreign currency account, still RBI approval is required. So what's your final conclusion? RBI approval is required. So examine whether the above transaction is exempt from approval. No, it is not exempt from approval. RBI approval is required over here. You got the whole point? So if a non-individual is making payment of commission to agent abroad, the commission is for sale of residential flat or commercial plot in India, and for this commission, if we need foreign exchange, which is more than the limit, then in that case RBI approval is required. What is the limit? 5% of the inward remittance or $25,000, whichever is higher. But however, there are transactions in Schedule 2 and Schedule 3 for which if we make remittance out of exchange earner's foreign currency account, EEFC account, then RBI approval is not required. But there are some exceptions to that, and that is this commission point. This commission point, even though if it is out of EEFC account, still RBI approval will be required. So final conclusion, RBI approval is required. Okay guys, then look at the second transaction over here. There's one more transaction. The second transaction is about clubbing LRS limit. See, in LRS, under liberalized remittance scheme, you can make a remittance of $250,000 every year, guys. Each person can make a remittance of up to $250,000. We will not require any RBI approval in that case. That is what the LRS scheme is all about, right? But however, we also have the clubbing concept where not just one person, all the members in the family, we can combine our LRS limit. So to the extent of the combined LRS limit, to the extent of the clubbed LRS limit, we can make remittances without any RBI approval. But here there's a catch the catch is, if I'm going to combine the LRS limit of my family members, and if I'm going to remit this money outside India, and with that money if I'm going to buy immovable property outside India, then in that immovable property, all these family members whose limits I combined, right, all of them have to be co-owners of that immovable property. Don't worry, I will re-explain. So in LRS, what's your limit? First of all, we'll go step by step. The limit is $250,000. Up to $250,000, you can make remittance. You don't even need RBI approval. But however, there's one more option which we have, and that is we can consolidate the limit of all the family members together. Like for example, in my family, if I have 4 people, I can club all the 4 limits together. So $250,000 per person into 4 people, that's going to become $1 million, guys. So up to $1 million, we can make remittance. We don't even require RBI approval. But the catch is, using this remittance under LRS, if we buy some immovable property outside India, then in that immovable property, all of these 4 family members should be having co-ownership. Okay, keep this in your mind. Now have a look at the question. The question says, Bob, a director at Skynex Limited, along with his wife. So Bob, his wife, his major son, and his father, 4 people, purchased a property in Mexico holding equal shares in the property. They collectively remitted $1 million during the financial year. Bob confirmed all family members complied with the applicable terms and conditions, and amount sent is within the limit prescribed for remitting funds to Mexico. Examine whether Bob and family members can remit this $1 million to Mexico in a single financial year without requiring any approval. See, ideally limit is $250,000 only. But here we're talking about 4 people. So 4 people consolidating their limit together, 4 people into $250,000 is going to become $1 million, guys. So up to $1 million, yes, they can remit. But they're remitting this to buy one property in Mexico. Now in that property, all these 4 people have to be co-owners. Is that condition fulfilled? Yes, the condition is fulfilled. The question says all of them are holding equal shares in the property. So condition is fulfilled. So they are co-owners of the property. They are equal owners of the property. So examine whether Bob and his family members can remit this without any approval. My answer will be yes. Even though in LRS limit is $250,000 only, here it's nothing but a case of consolidating the limit of all the family members together, which is definitely allowed. So because we have consolidated the limit of family members only, it is still within the limit and it is going to be a permitted transaction. We don't even require any RBI approval. Under LRS itself, this transaction will happen. Okay. Then look at the question number 24. Question number 24 is about donations. Bhargav Limited had total foreign exchange earnings of $12 million in the last 3 financial years. What is the maximum amount the company can donate without RBI approval? Without RBI approval, how much we can donate? So the question is about donation. See, even donation comes under Foreign Exchange Management Current Account Transactions Rules. It's a current account transaction. It comes under Schedule 3. So Schedule 3 indicates what? It is a permitted transaction, but we require RBI approval. So if a non-individual makes a donation, and if this donation is more than the limit, then in that case RBI approval will be required. It's again a Schedule 3 current account transaction. Now comes the question that what is a limit? The limit again depends upon the foreign exchange earnings. So 1% of the foreign exchange earnings of the last 3 years, either this number or $5 million, whichever is lesser will become your limit. Okay, so if I'm going to make a remittance of foreign exchange for donation, if it is more than this limit, then only RBI approval is required. So 1% of foreign exchange earnings of 3 years. Here my foreign exchange earnings of 3 years is $12 million. So 1% of this is going to become $1,20,000. So $120,000 or $5 million, whichever is lesser will be the limit. So $120,000 will be the limit. Here they're just asking us what is the maximum amount the company can donate without RBI approval. My answer will be $120,000. Up to this, the company can donate without requiring RBI approval. If the company wants to donate more than $120,000, then in that case we will require RBI approval. Understanding? So all these transactions we have seen, they are all current account transactions, guys. This rupee state credit route, this one, rupee state credit route commission, this was current account transaction, schedule 1, prohibited transaction. Then this payment of commission to agent abroad for sale of residential flat or commercial plot in India. This is also current account transaction, schedule 3. It requires RBI approval. Then this was LRS. Then we had this question over here with regards to donation. Even this is schedule 3 current account transaction, permitted, but permitted with RBI approval. If you are doing the remittance more than the limit, then only RBI approval is required. Okay. Then comes the second subdivision over here. One more subdivision we have. Preto Limited wants to make remittance 6% of investment brought into India. Does it need RBI approval? Now even this is same schedule 3 current account transaction. Again it requires RBI approval. So I'll tell you the provision over here. It's very simple. If the company is an Indian company and it wants to make a remittance of foreign exchange, okay, it wants to send foreign exchange outside India, and this is towards reimbursement of pre-incorporation expenses. If this remittance happens to be more than the limit, then RBI approval is required. The limit over here is 5% of the investment which is brought into India, or $100,000, whichever is higher. So here they have not told us the amount of investment brought into India. So we can't calculate and all. We'll just have to say that if this remittance is more than this limit, then RBI approval will be required. Understanding? So if Indian company is making a remittance of foreign exchange and if this remittance is towards reimbursement of pre-incorporation expenses, if this remittance is more than the limit, then RBI approval is required. The limit is 5% of the investment brought into India, or $100,000, whichever is higher. Now come on guys, let's come to question number 25. We are moving on to our General Clauses Act now. So I'll just quickly remind you about a particular section first, then we will enter into the question. So we're talking about section 17 and section 18 of the GC Act. Now these sections say that if a particular law is applicable to a corporation, or if a particular law is applicable to a functionary, then that law will also automatically apply to the successors also. Basically, the law does not have to specifically mention that this particular provision will apply to successor also. Like that, it doesn't have to mention. If a particular law is applicable to a corporation, or if it is applicable to functionary, it will automatically apply to successor also. Okay, this entire question is based on this one small simple thing. Look at the question. So we're talking about National Infrastructure Authority Act 2005. It is a central act which is enacted after the commencement of the GC Act. This act provides that the chairperson of the National Infrastructure Authority, this chairperson will have the power to grant license for strategic highway projects. So according to this act, whole power to give license is with whom? With the chairperson. Then what happened? In 2024, the designation of chairperson was replaced by managing director through an amendment to the Parent Act. Powers and functions earlier exercised by the chairperson were now formally vested in the managing director. So earlier the powers were with the chairperson, now all the powers are given to managing director. Earlier chairperson was issuing license, now managing director will issue the license. So earlier all the powers, all the provisions were applicable to chairperson. Now the managing director becomes the successor. The same provision, same powers, everything managing director, the successor will have. A dispute arose when a company challenged the validity of the license granted by managing director on the ground that original provision of the act referred only to the chairperson and not to the managing director. So this company is challenging, this company is saying that in the original act, the powers are given to chairperson and not to managing director. So therefore, if managing director gives a license, that license will be invalid. Like that, this company is challenging. This company's challenge will definitely be invalid. Why? Because if the act is referring to a corporation or functionary, it is also automatically referring to the successor. So in this question, when the act is referring to the chairperson, the act is automatically referring to managing director also. So the same powers which the chairperson had earlier, the same powers the successor managing director will have now. So if managing director gives a license today, it will be valid. So what the company is saying is not correct. The company contends that since the Act specifically mentions chairperson, only that office holder could exercise the power and not any successor authority. No, this is wrong. When the law gives power to a corporation or functionary, it will also automatically apply to successor. So, with reference to the provisions of the GC Act relating to successors, examine whether the license granted by managing director is valid. Yes, it is definitely valid. The managing director will become the successor of the chairperson. So, whatever license was issued by chairperson was valid earlier, so same way now whatever license is issued by the managing director will also be perfectly valid. Okay, this was simple question number 25, just targeting the successor point. All right, then come to question number 26. Question number 26 is a combination of Companies Act also, General Clauses Act also. Read the question with me. ABC Limited is in the business of manufacturing life-saving drugs. Company has plant in Kerala. Turnover for the last financial year crossed 52 crores. During the first quarter of the current financial year, company's turnover has already reached 50 crores. ABC Limited is expecting its turnover to reach 200 crores for the financial year 24-25. Company held board meeting on 1st August 24 and decided to appoint a cost auditor for the financial year. According to the GC Act 1897, by what date must ABC Limited file the cost auditor appointment, and how is this timeline calculated? Now see, they are not asking you whether cost audit is applicable or not, whether cost auditor has to be appointed or not. They are not asking you all that. They are just asking you by what date must ABC Limited file the cost auditor appointment and how is the timeline calculated. They are just asking you the timeline calculation. See, I'll tell you the provision first. Whenever a cost auditor is appointed, the company has to inform the central government about the appointment of cost auditor. The company has to file the cost auditor appointment with the central government. This means once a company appoints a cost auditor, the details about this appointment company has to inform central government. Within how much time? There are two time limits, guys. Time limit number one, we have to see the board meeting in which this appointment is made from the date of the board meeting within 30 days. Okay, this is the first time limit. Second time limit is we have to see when did the financial year commence. From the commencement of the financial year within 180 days. So we have two time limits. Out of these two time limits, whichever is a earlier time limit, by that date the company has to file this appointment with the central government. So here if you see when was the board meeting held, board meeting was held on 1st August 24. 1st August 24 plus 30 days will be what? 1st August 2024 plus 30 days is going to be 31st August 2024. See, you know, right, in General Clauses Act, when I say 30 days from 1st August 24, you will ignore 1st August 24. You will start counting 2nd August only. 2nd August onwards only you will start counting. So 1st August plus 30 days will be 31st August 24. Then from the commencement of the financial year 180 days, let's count. So the year commences in April. So 30 days in April, 31 days in May, 30 in June, 31 in July, 31 in August. So till 31st August, it's how many days? It's going to be 153 days, but we need 180 days from the commencement of the financial year, which means in September month, how many more days we need? We need 27 more days in September. So 180 days from the commencement of the financial year is going to be 27th September 2024. So out of these two dates, which is the earlier date, 31st August 2024. So by 31st August 2024, we are supposed to inform the central government about the appointment of the cost auditor. Okay. So 30 days from the board meeting or 180 days from the commencement of the financial year, whichever is earlier, which over here is 31st August 24. Then they are asking us ABC Limited's failure to appoint cost auditor where it is statutorily required constitutes offence. Yes, if cost auditor is required, but if we fail to appoint cost auditor, it will become an offence, definitely. What is meant by offence under GC Act? They are asking us the definition of offence. See, I'll show you very simple definition we have. We have the definition of affidavit. We have the definition of good faith. We have the definition of document in GC Act. Similarly, we have the definition of offence also. GC Act says offence means an act or an omission which is punishable by law. So either you did something, an act, or omission. You did not do something that you were supposed to do. That act or omission is punishable by law, then it becomes an offence. So what is an offence? Offence is nothing but an act or an omission which is punishable by law. Okay, this was your question number 26, testing you on two things. Number one, the cost auditor appointment we have to inform central government about the appointment, the time limit calculation regarding that, and this definition of offense. Okay, now come to question number 27. Now question number 27 is about pro rata calculation of duty. I'll show you the provision first, then only we will go to the question. Look at this. So the provision says duty to be taken pro rata in enactments. When any duty of customs, excise, etc. is leviable on any quantity, weight, measure or value of any goods or merchandise, then a similar duty is leviable according to the same rate on any greater or less quantity. Understanding? In simple words, whenever duty has to be calculated, it always has to be calculated on a proportionate basis. Pro rata is a Latin term used to describe proportionate allocation. The key point over here is similar duty is leviable according to the same rate on any greater or less quantity. Okay, keep this in your mind and come to the question. Under an enactment, excise duty of 10 rupees is levied on every 100 liters of certain chemical produced in the factory. So if we produce 100 liters, we'll have to pay 10 rupees duty. During inspection, it was found that factory A produced 350 liters. So if you do pro rata calculation, if you produce 350 liters, then how much duty you will have to pay? Proportionate calculation, guys. 350 into 10 by 100, 35 rupees duty you will have to pay. But see what happened. But this factory, they paid duty only for 300 liters, not for 350 liters. They paid for only 300 liters. Why? Arguing that the act only specifies duty per 100 liters and does not mention fractional quantities. Wrong. The similar duty is leviable at the same rate on any greater or lesser quantity. It doesn't have to be in multiples of 100. Whatever greater or lesser quantity, simple proportionate calculation we will do, that will become your duty. Duty is always calculated on pro rata basis, on proportionate basis. It is not every 100, it is not in multiples of 100 and all. It has to be simply on proportionate basis. So with reference to the GC Act, determine whether the factory is liable to pay excise duty on the remaining 50 liters. Yes, you are supposed to pay duty on 350 liters. You have paid only for 300 liters. So for the remaining 50 liters, yes, you have to pay the balance duty. Support your answer with reasoning. Section 12. Okay, so this is a duty to be paid on pro rata basis. So whatever is a greater or lesser quantity, on that quantity you will have to pay the proportionate duty. Okay, this is your question number 27. So this was your GC Act discussion. Now coming to interpretation of statutes, come to question number 28. Now question number 28 says, the central government enacted the Industrial Regulations Act 1985. One of the provisions of the Act uses the term processing unit, but the term is not specifically defined in the statute. Okay, so this Act uses the word processing unit, but this word is not defined. The whole question is about this one word only. Alright, so what happened is, for the last 30 years, licensing authorities across the country have consistently treated small packaging units as processing units. Last 30 years, it's not a small period of time. For 30 years, we have treated small packaging units as processing units. Several industries have been granted license on this basis. Legislature has amended the Act multiple times over the years, but it has never altered this interpretation. Further, in one case, High Court also accepted this long-standing practice while deciding a dispute. So what has happened over here? Over the years, even though this particular word processing unit is not defined, over the years, we now have a custom, guys. We now have a usage, guys. Custom, usage, practice. This is a concept which comes into the picture. Over the time, when across a certain number of years, we have been giving the same definition to a particular word over the years. Now suddenly we can't change it. If you see, even though the particular act has been amended so many times, they've never given clarification about this word. Also, we have a judicial decision, we have a High Court decision supporting this interpretation. So now, this is the interpretation of the word. Now it is decided now that small packaging units will also be considered as processing unit. It is now decided. So even though the definition is not given in the act, but we can interpret the meaning of words through custom, usage or practice. Over time when a particular word has been interpreted in a certain manner consistently over time, and if the legislature is not taking any action in changing that interpretation, then it means that the interpretation is now fixed. Now we have to continue to follow the interpretation. It becomes customary. We suddenly can't change the interpretation. Then what happened? Recently, a new regulatory authority has taken a different view and denied license to a packaging unit, arguing that the term processing unit should be interpreted strictly as per dictionary meaning and not according to past administrative practice. This is wrong. It's a custom. It's become a usage now. It's become practice now. We have to interpret processing unit as it includes packaging unit also. We also have a high court decision. We also have a judicial decision supporting this. Now suddenly you cannot change this meaning like this. The affected company challenges the decision and contends the long-standing usage and practice should guide interpretation of statute. While interpreting a statute, what is the effect of usage or customs and long-standing practice? Explain with reference to relevant principles and Latin maxims. See, listen to me. Look at this. Read this with me. It says, usage or practice developed under the statute indicates the meaning to be given to words. A uniform practice continued under an old statute and inaction of the legislature to amend the same shows that the practice so followed was based on the correct understanding of the law. This is exactly what has happened, guys. Uniform practice. Since 30 years, the same interpretation we have been giving uniformly. Then inaction of the legislature to amend the same. The legislature, the law has, this particular act has been amended so many times, but never the legislature has amended this particular interpretation. So now it is concluded that the word processing unit will include small packaging units also. It is concluded. The practice so followed all these years, the interpretation so given all these years is based on the correct understanding of law. It is concluded. Now we suddenly cannot change this interpretation. Then they ask us what Latin principles are to be applied over here. Two Latin principles. One is optima legum inter praesest consuetudo and the other is contemporanea expositio est optima et fortissima in lege. Optima legum, this one, which means that custom is the best interpreter of law, which means if you have been interpreting a certain provision in a certain manner since years and years, now it's become a custom. You have to continue to follow the custom. Then contemporanea expositio, which means the best way to interpret a document is to read it as it would have been read when made. So these are the two Latin maxims which are relevant with respect to this discussion. Then comes the next question over here, the last question. Very simple question. The question says, XYZ Act contains several provisions relating to filing of documents and communication with authorities. Section 8 of the Act says documents may be submitted to the authority. It doesn't say the mode, it just says documents have to be submitted to the authority. Section 15 provides that documents shall be submitted in electronic form. Section 22 further specifies that all applications and returns shall be filed online through the designated portal. A company submits important documents in physical form relying on the general wording of Section 8. Authority rejects the submission stating that documents must be filed electronically. Company argues that Section 8 permits submission in any manner, including physical mode. In light of the above, discuss how the provisions of the Act should be interpreted. Should Section 8 be read independently or in conjunction with other provisions? This is nothing but the rule of interpretation which says read the statute as a whole. Basically, you should not read each section individually. You should not read each section independently. That's wrong. You should read all the provisions together as if it is one document. You remember harmonious construction? That's the whole premise of harmonious construction, right? That you should read the provisions of the Act in such a manner that you are able to give effect to all the provisions. So here they are saying Section 8 says the document has to be submitted to the authority. It doesn't say the mode. But we have Section 15 which says electronic form. We have Section 22 which says to be filed online. So you're supposed to do a joint reading of all the sections together. Do not read each section as an independent entity altogether. No, do a combined reading of all the sections together. So the combined interpretation will be that documents have to be submitted to the authority in electronic form through the designated portal. That will be a combined reading of these three sections put together. So what the company has done, company has submitted documents in physical form. This is definitely Incorrect. Company, you should be doing the filing in electronic form only. Yes, Section 8 does not say the mode, but you can't read Section 8 independently. You have to read Section 8 along with Section 15, along with Section 22. Accordingly, joint interpretation you'll have to make. You'll have to read the statute as a whole. Okay, so this was your question number 29. Now come on guys, let's move on. So we are done with the Jan 26 question paper, the descriptive questions. We are done with the new questions in your May 26 RTP, the new questions in your May 26 MTP1 and MTP2, both descriptive and MCQ. All the new questions in the MTP and RTP of your May 26 exam we are done with. Now what are we left with? Jan 26 question paper, case-based MCQs we're left with. That is what we're going to take up now one by one. Okay, look at this very first case scenario over here. The question, we don't even have to read the story over here. We can straight away come to the questions. Look at the questions. The first question says, default by Sunset Private Limited in repaying deposits raised from the public and the initiation of proceedings under 76A will result in only the company being punishable with fine, directors not liable. Directors liable only if willful fraud is proved. Both company and every officer in default being liable with imprisonment possible. Only depositors entitled to civil recovery, no criminal liability. Basically, the question is about Section 76A, the punishment section. So, in case there is a violation with respect to the deposit provisions, the company is also punished. The officer in default is also punished. This is your Section 76A. Company is also punished. Officer in default is also punished. The company's punishment is fine which is minimum 1 crore and maximum 2 times the amount of deposits. The officer in default's punishment is imprisonment and fine, guys. Imprisonment maximum 7 years. Fine will be minimum 25 lakhs and maximum 2 crores. So in case it's a violation with respect to the deposit provisions, the company is also punished. Officer in default is also punished. Company is punished with fine. Officer in default is punished with imprisonment and fine. Now see what is the question saying. Only the company is punishable with fine. Directors are not liable. Wrong, guys. Officers in default are also punished. Then directors liable only if willful fraud is proved. No. Both company and every officer in default being liable with imprisonment possible. Option C. So company also, officer in default also, both are punished and imprisonment is also possible. Okay, that's your first question. Then comes your second question. For failure to register a charge created in favor of Horizon Bank, the effect under Section 77 read with Section 86. Now this is something which we spoke about even some time back. In the entire charges chapter, if you do any violation, there's only one single punishment. Punishment is given in Section 86. Section 86 says company will also be punished. Officer in default will also be punished. Company's penalty will be 5 lakh rupees. Officer in default's punishment will be 50,000 rupees. That's all, guys. So that is what they're asking us. The charge is void against liquidator and creditors, and company along with officers are liable for penalty. Option A. So if the charge is not registered, for failure to register a charge, if you don't register a charge, the charge will become void towards liquidator and creditors. This is your effect of non-registration of charge. Over there you will find this point. The charge is void against liquidator and creditors, and company also, officers also, company also, officers in default also, both will be punished with a fine. Okay. Then comes the third question. In the adjourned general meeting of Sunset Private Limited, where only one shareholder attended and resolutions were passed, validity of such resolutions will be determined by what? See, if my AGM, or let's say any general meeting for that matter, in a general meeting, if there is no quorum within 30 minutes, then what will happen? The general meeting will get adjourned, guys. It will get adjourned to same time, same day, same place in the next week, or any other date, time, place which the board of directors will decide. Now, in this adjourned general meeting, also if there is no quorum within 30 minutes, then what will happen? In that case, how many ever members are present in the meeting, we will consider them itself as quorum and we can continue with the meeting. That is what has happened over here. In the adjourned general meeting, there's only one member. Doesn't matter. In the adjourned general meeting now, whoever is present, how many ever members are present, they will constitute as quorum and we can continue with the meeting. So, the validity of the resolutions will be determined by AOA? No. Section 103. 103 is a quorum section which provides that members present at adjourned meeting form quorum. Option B. So, in the adjourned meeting, if only one member is present, it is fine. As per section 103, in adjourned meeting, whoever are the members present, how many ever members are present, they will constitute as quorum and we can validly transact business in the meeting. Okay, so this was your first case-based MCQ. The first question was about section 76A, your punishment with respect to deposits. The company is punished, the officers in default are also punished, company is punished with fine, officer in default is punished with imprisonment and fine. Second question is about punishment under section 86 with respect to charges. If the charge is not registered, then the charge will become void towards liquidator and creditors, and also there will be punishment. Company also will be punished, officer in default will also be punished. Then our third question was about quorum in the adjourned meeting. If my general meeting is adjourned because of want of quorum, now in the adjourned meeting, whoever are the members present, they itself will constitute as quorum. Okay. Then come to the second case scenario. Here we'll have to read the story, guys. The question says Novus Labs LLP was formed in 2019 by 3 practicing technologists. Asha, designated partner number 1, Rohan, designated partner number 2, and Meera, partner. So there are totally 3 partners. In 2024, Novus decided to convert into a private limited company. So LLP is getting converted into a company to raise institutional capital and to offer stock options to employees. LLP completed conversion formalities on 10th October 2024. Novus Labs Private Limited was incorporated. Asha, who had acted as LLP's designated partner and had been the compliance lead, becomes a managing director. So Asha is a managing director of the new company now, and she is having 60% of the equity. Then Rohan became non-executive director and Meera took 10% equity, while the balance was allotted to 2 angel investors. Within the same financial year, Novus Labs Private Limited planned 2 fundraising steps. First, on 20th November 24, the board approved a private placement offer. It's a private company. It's making a private placement offer to identified investors aggregating to 205 persons. We can make private placement offer to maximum how many people? To maximum 200 people only. Here we are making the private placement offer to 205 people. Invitation included 5 qualified institutional buyers and 10 employees to be issued under ESOPs. So this we know very well. In a financial year, the company can make a private placement offer to maximum 200 people for each kind of security, guys. But this does not include qualified institutional buyer and does not include employees to whom we are issuing ESOPs. So in this question, the company has made the private placement offer to 205 people. This includes 5 qualified institutional buyer. I will exclude qualified institutional buyer. It also includes 10 employees to whom we are issuing shares under ESOPs. We will include employees to whom we are issuing under ESOPs also. So we are technically making the private placement offer to 190 people only, which is well within the limit of 200, guys. So the board relied on the fact that these investors were known to the company, treated the issue as a private placement. Then second, in March 2025, company proposed a rights issue to raise further working capital, one right equity share for every 2 shares held, and sent the notice of offer to shareholders only 2 days prior to opening the issue. This is where section 62 comes into the picture. Section 62 very clearly says that whenever the company is making a rights issue, the company should send the letter of offer to the shareholders at least 3 days before opening the issue, guys. But however, we have an exception. If the company happens to be a private company and we have the consent of at least 90% of the members, either in writing or by mail, if we have the consent, then we can send a shorter notice also, not a problem. So here the company has given only 2 days notice. Okay. So 94% of the members had earlier given written consent via email that the company may adopt a short notice period. So therefore perfectly fine, guys. Even though the company has sent less than 3 days notice, we have the consent of at least 90% of the members. 94% of the members have given consent, therefore perfectly fine. Then during the private placement process, some foreign subscribers were nationals of neighboring country that share land border with India. Company secretarial team receives queries whether any additional government approval under FEMA were required. Meanwhile, Asha, now MD, received a notice from an investor alleging non-compliance with procedural formalities for private placement and warning of invocation of penalties and refund obligations under Companies Act. So understanding what is happening. Earlier, Asha was the designated partner. Now she is the MD. She received a notice from an investor alleging non-compliance with procedural formalities for private placement and warning of invocation of penalties and refund obligations under Companies Act. So there's some non-compliance for which Asha has received a notice. Company's finance head is not sure whether 205% invitation is treated as public offer, whether QIBs and employees are to be counted in 200% threshold, whether dispatch of short notice 2 days for right issue is valid for private company, and whether Asha, previously designated partner, has any special filing or liability exposure for procedural defaults. We'll come to the MCQs now, then we'll get back to the story in case it is required. The first question over here. In the facts above, company issued private placement invitation letters to 205 identified persons in aggregate during the financial year. Which of the following statements is correct? The issue will be deemed to be public offer. Wrong, guys. Only if the company is making a private placement offer to more than 200 people, only then it is deemed to be offer. But here we have checked that even though we have made the offer to 205 people, it is in effect 190 people only, which is less than 200. So therefore it is within the limit. So therefore there is no question of deemed public offer and all over here. Then company need not file any return of allotment for private placement issues. Wrong. Even in private placement we have to file return of allotment. Then even if excluded, because any single allotment to more than 180 persons, 180 number we did not have, we had the 190 number. Then the issue will not be deemed a public offer because QIBs and employees under ESOPs are excluded, correct? While computing the 200% threshold, after excluding them, the count is 190, correct? Which is less than 200. So it remains a valid private placement subject to other procedural compliances, option D. Okay, then the next question says, company sent the rights issue notice to the shareholders only 2 days prior to opening the issue. We concluded, remember, even though it is less than 3 days, it is still fine because we have consent of 90% of the members. So come on, let's get back to the question. Let's read the question again. The company sent the rights issue notice to shareholders only 2 days prior to opening the issue. The shorter notice point. Considering section 60 to section 62 implications and considering conversion of LLP into company. Remember, it was an LLP earlier, which later got converted into company. Asha was designated partner earlier. She is now the managing director. Which statement is correct? The rights issue is valid in a private company since the shareholders' written consent exceeded 90%. So, the 2-day dispatch is acceptable for private company. Correct, guys? It's a private company. It is a shorter notice, but we have consent of at least 90% of the members. So, therefore, the rights issue is perfectly valid. And then, Asha, she was earlier the designated partner of the LLP. So, therefore, she was responsible for compliances and all, legal compliances. Designated partner only is liable for legal compliance in LLP, right? So now that the company has converted into company, she will be treated as officer or director for compliance purposes and is bound by filing or penalty provisions if default occurs. Correct. So option A. So point number 1, rights issue is valid because we have consent of 90% of the members. And secondly, earlier, Asha was designated partner, so she was responsible for legal compliances. Now that the LLP has gotten converted into a company, she's a managing director and now she will continue to be liable for compliance issues. Now, come on, let's come to the third case scenario. The third one says, in Hyderabad's tech hub, Horizon Innovations Limited was a fast-growing company, famous for digital power solutions. So the company is Horizon Innovations Limited. In 2022, the company faced a serious problem, not with its technology, but with the auditor who was supposed to audit its financial statements. At the AGM on September 30, 2021, the shareholders appointed Messrs. Vikas and Associates as statutory auditor for 21-22. The firm's lead partner Vikas Reddy was a respected CA with 15 years of experience. Most shareholders trusted him, but one investor, Anjali Desai, who owned 10% shares, was suspicious. When Anjali checked the auditor's background, she found the following issues. So in this company, Horizon Innovations Limited, Vikas and Associates is the auditor. Now we have found some issues. What issues? Vikas Reddy's spouse owned 10,000 shares of 100 rupees each. So total face value which she is owning is 10,000 shares of 100 rupees each. Total 10 lakh rupees face value she is holding, which is going to be wrong. Remember, relatives can hold maximum 1 lakh rupees face value only, but her the partner's spouse is holding 10 lakh rupees face value worth of shares, which is definitely wrong. Disqualification will be attracted. The firm took a loan of 50 lakhs from Horizon in 2020, still unpaid. The auditor owes money to the company. Again, disqualification is attracted. Then Vikas has also provided tax consultancy services to Horizon in 2021. Section 144 prohibited services. Then firm did not submit the mandatory eligibility certificate under Companies Act 2013. You must have learned that whenever we appoint an auditor, the auditor is supposed to give a certificate saying that the number of audits that he has totally is within the limit, then that the auditor is eligible to be appointed, the auditor is not attracting any disqualification, the appointment is as per Chartered Accountants Act, as per the Companies Act. So he has to give that eligibility certificate, but that certificate has not been given by the auditor. Anjali complained to the ROC Hyderabad saying that auditor was ineligible under section 141. Investigation confirmed her claims. ROC ruled that Vikas and Associates was ineligible and must vacate the office under section 141 subsection 4, imposed penalties. Horizon was fined 2 lakh rupees for appointing an ineligible auditor. Vikas and Associates was fined 50,000 rupees for accepting the appointment. Further, Horizon was ordered to call an EGM within 60 days to appoint a new eligible auditor. Now see the question. Vikas and Associates argued that 10,000 shares held by Vikas Reddy's wife was held in her personal capacity and not in firm's name. It doesn't matter. If the auditor's relatives are holding securities in the company, if it is more than 1 lakh rupees face value, then the auditor is disqualified. You can't be an auditor in that particular company. So how should this argument be treated? Is it an acceptable argument? Vikas and Associates' argument is that the spouse is owning shares in personal capacity only. Argument is not acceptable. So acceptable will become wrong. So not acceptable, option C. Then, audit firm did not furnish eligibility certificate as prescribed before appointment. What is the importance of the certificate? The certificate is a mandatory requirement, guys. So, whenever we appoint a person as an auditor, before appointment, he has to give a certificate saying that he is not disqualified, neither under Companies Act, nor under Chartered Accountants Act, that if he accepts this assignment, it is within the maximum permissible limit. Then he also has to give the list of proceedings which are going on against him. It's a mandatory certificate. So, it's a voluntary self-declaration? No. It is a mandatory requirement under section 139 subsection 1 read with rule 4, confirming that auditor satisfies eligibility criteria. Yes. It's a requirement only in listed companies. No. Certificate issued by ICAI attesting the auditor's professional competence. No. Option B. Then comes the 8th question. Following the regulatory authority's decision, Horizon Innovations Limited was penalized and directed to convene an EGM to address the auditor's disqualification. Which of the following provisions applies correctly? Keep in mind, as soon as the auditor attracts a disqualification, immediately he'll have to vacate the office. Keep that in your mind. Now come to the options. When auditor becomes disqualified, auditor must vacate the position and such vacation will become casual vacancy and company is required to appoint another eligible auditor. Correct, guys. Whenever the auditor dies or attracts a disqualification or resigns or is removed, all of these cases there will be casual vacancy and casual vacancy has to be filled by the company. So option A. Now come on guys, come to the 4th case scenario. This is regarding FEMA. So the question says, Globacom Private Limited, a tech services company headquartered in India, plans to engage in several foreign exchange transactions. Send sponsorship funds worth $130,000 to support a private tech conference abroad organized by non-governmental association. Then remit royalty payments $150,000 under technical collaboration agreement for licensing software developed overseas. Then make a marketing payment exceeding 15,000 rupees in a foreign print publication to promote inbound tourism. Sponsor several cultural exchange tours for college students for $80,000. Finance team must determine which transactions are permitted, which require government approval, which are strictly prohibited under the applicable provisions of FEMA. So come on, let's see the questions one by one. The first one, related to the remittance of the amount mentioned for sponsoring a private tech conference abroad, which of the following is correct option? See, in your foreign exchange management, current account transactions rules 2000, okay? You have schedule 2 which talks about those current account transactions which are permitted but they require central government approval. So in those transactions, one of those transactions is remittance of foreign exchange towards prize winnings or sponsorship relating to sports activities. So if I want to send foreign exchange relating to prize or sponsorship for sports activity, for that I will require central government approval. Here it is sponsorship but not relating to sports activities, relating to private tech conference. So therefore it will not come under schedule 2. Central government approval I don't require. Therefore it will become a freely permitted transaction. So allowed freely as it is promotion of trade, option A. Prohibited under schedule 1, it is not a prohibited transaction. Requires approval under schedule 2, no. Had the sponsorship been relating to sports activity, then it will require central government approval, but it is not relating to sports activity, so no central government approval is required. Then does not require approval from government if routed via EEFC or RFC account. This will come into the picture only, first of all, it fits under schedule 2. It doesn't even fit under schedule 2 because it is not relating to sports activity. So option A, allowed freely. Then comes your next question, above said royalty remittance. Now this royalty remittance point, it's first of all current account transaction or capital account transaction. See, it will be a capital account transaction only if it alters your assets and liabilities. This is royalty, this is an expense. This is not going to alter your assets or liabilities. So first of all, it will be a current account transaction. Now in current account transactions, tell me, is it coming under schedule 1? Is it a prohibited transaction? No guys, it is not a prohibited transaction. Then does it come under schedule 2, central government approval? There you have cultural tours, you have your foreign print media, you have sponsorship, prize winnings relating to sports activity, then you have P&I club, you have all of these points. But do you have this royalty point in schedule 2? No, so doesn't come under schedule 2 also. Only allowed if remitted from EEFC or RFC account. No such provision also we have for royalty. So therefore, elimination approach is what we did over here. Freely permissible without approval, option A. Alright, then comes your question number 11. Globacom has made 2 other remittances. Marketing payment in foreign print media to promote inbound tourism. See, foreign print media, somewhere you have learnt in FEMA. If you recall, it's a current account transaction. It comes under schedule 2 guys, the transactions which require central government approval. So there you have learned that if the entity is state government or state government's PSU, if they are making a remittance for advertisement in foreign print media, if it is more than $10,000, then they require central government approval. But here, is the entity state government? Is the entity PSU of the state government? No. So even though they are making an advertisement in foreign print media, no approval is required guys. They can freely do it. No approval will be required. Central government approval will be required only if this foreign print media advertisement is done by state government or its PSU. Here it's not by state government, not by state government's PSU. So it will not come under schedule 2. No central government approval not is required. Freely we can do it. Then cultural exchange tour. For cultural tour, here we require central government approval. This will come under schedule 2. So which of the following is correct option? Both are freely permissible? No. Second one requires central government approval. One is allowed freely, but 2 requires prior government approval. Yes, option B. So foreign print media, this is freely permissible, no approval is required, but cultural tour requires central government approval. So option B. Okay guys, this was your case-based MCQ relating to FEMA. So first was sponsoring. Any prize winnings or sponsorship relating to sports activity, for that we require central government approval. But this was relating to private tech conference, so no approval is required. Then for royalty remittance, we did elimination approach. It's a current account transaction. It doesn't come under a prohibited category. It doesn't come under schedule 2. Therefore, it is freely permissible. Then we spoke about this marketing payment in foreign print media. Advertisement in foreign print media requires central government approval only if the entity is state government or state government's PSU. This is any other entity, so no central government approval is required. But for cultural tours, central government approval is required. Okay. Then come to your case scenario 5. Here the question says ABCD Capital Limited, a listed public company, was found guilty of manipulating share prices through false disclosures in quarterly financial statements. So it's a listed company, it has made false disclosures. Company's managing director, Mr. Arvind, was charged under Section 447 of the Companies Act for fraud and Regulation 9 and 10 of SEBI, Prohibition of Fraudulent and Unfair Trade Practices Regulations, read with Section 24 of SEBI Act, for misleading investors and distorting the securities market. So this entity, Messrs. ABCD Capital Limited, a listed company, they have made false disclosures. The managing director is being charged under Companies Act also, under SEBI regulations also. Okay. Then SEBI adjudicating officer imposed monetary penalty of 25 lakhs and recommended criminal prosecution. Later, special court under the Companies Act also imposed a fine of 10 lakh rupees and 3 years imprisonment on Mr. Arvind for the same fraudulent act. Mr. Arvind appealed, raising two legal objections. He cannot be punished twice for the same act of fraud under both SEBI and Companies Act, that the fine imposed under SEBI Act cannot be recovered using Code of Criminal Procedures. Don't do any overthinking, straight away come to the questions. Which of the following statement correctly applies to Mr. Arvind's claim of double punishment? Double jeopardy, guys. So General Clauses Act. You must have learned that if a person does an offence, for one particular offence, you can be punished only once, guys. You should not be punished under two acts for one same offence. That is one thing you would have learned. But you would have also learned that the trial can be under both the acts. That person can be convicted also under both the acts. But for one particular offence, he can be punished only once. For the same offence, he cannot be punished twice. Keep that in your mind and look at the options. He cannot be trialed under both SEBI and Companies Act. No, trial can be under both the acts. He can be punished twice, definitely wrong. He can be trialed and convicted under both enactments, but cannot be punished twice for the same offence, option C. Trial can be under both the acts. He can be found guilty. He can be convicted under both the acts. But for one offence, he cannot be punished twice for the same offence. He can be punished only once for one offence. So option C. Then listen, there's one small concept in your General Clauses Act, okay. The concept says that in any law, if any fine has to be recovered, then Indian Penal Code will also apply. Code of Criminal Procedure will also apply. Indian Penal Code also will apply. Recovery of fines. If any fine has to be recovered under any law, any warrant and all has to be issued to recover fine, then Indian Penal Code will also apply. Code of Criminal Procedure will also apply. Look at the question now. If SEBI Act 1992 does not expressly exclude the application of Code of Criminal Procedure provisions for fine recovery, which of the following is correct as per the provisions of GC Act? Fine cannot be recovered under Code of Criminal Procedures, wrong. Code of Criminal Procedure provisions like issuance of warrant for levy of fine will automatically apply. Option B, guys. Whenever any fine has to be recovered under any act, automatically the Indian Penal Code and the Code of Criminal Procedure will apply. So the Code of Criminal Procedure will automatically apply, option B. Okay, this was your General Clauses Act. Your first learning over here is, if a person does an offence, then trial can be under both the acts. He can be convicted under both the acts, but he cannot be punished twice for the same offence. And question number 13, this is about any recovery of fines under any law as per GC Act. Immediately Indian Penal Code and Code of Criminal Procedure will start applying. Okay. Then come to your last case scenario over here. The question says, Aquarius Design LLP was incorporated on 1st April 23 with 3 partners, Arjun, Anjali and Nakul. Arjun and Anjali were designated partners. Nakul was an ordinary partner. Then the question says, in August 23, Nakul withdrew 3 lakhs from LLP's bank account without prior consent and used it to repay his personal car loan. Wrong, guys. Nakul, one of the partners, he withdrew 3 lakhs from LLP's bank account without prior consent and he used it to repay his personal car loan. So for this, he will be personally liable. Then LLP later suffered a major business loss and defaulted on a vendor payment of 7 lakhs. Meanwhile, Anjali went abroad for 6 months and stopped taking part in management but remained formally a designated partner. Please keep in mind that in this question, Arjun and Anjali, they are designated partners. In addition to that, we also have Nakul as an ordinary partner. Okay. Then what happened in Jan 24, LLP admitted a new partner, Bhim. So a new partner, Bhim, was introduced, a relative of Arjun, but no notice of his admission was filed with ROC. Remember, whenever a new partner is admitted, within 30 days of his appointment, we have to inform ROC. But here they did not inform ROC. Around the same time, LLP borrowed 10 lakh from Mr. Sharma, who believed Anjali was still actively managing the firm. Later, an internal audit revealed that Arjun knowingly prepared a false statement of accounts and solvency showing profits, though the LLP was in serious financial trouble. LLP failed to file that statement within the prescribed period and continued business till October 2024 when Mr. Sharma demanded repayment. Look at the questions now. Is Nakul personally liable for the 3 lakh withdrawn from LLP funds for personal use? Remember, Nakul, one of the partners, he had withdrawn 3 lakh from the LLP for his personal use. Will he be personally liable for that? Of course, he will be personally liable. So, answer to question number 1 is of course yes. Is Anjali, who was a designated partner but inactive and abroad, personally liable for vendor debts? Any partner, whether designated partner, whether ordinary partner, no partner will be personally liable for LLP's debts. So is Anjali personally liable for vendor debts? Of course not. Any partner, every partner will have limited liability only. No partner will be personally liable for the LLP's debts. So even though Anjali is a designated partner, she will not be personally liable for LLP's debts. So no. So yes and no, option D. Then, is Bheem liable to Mr. Sharma for LLP debts incurred before his admission since no notice of admission was filed? Doesn't matter. See, any partner, any new person becomes a partner of the LLP even before he became a partner. For past transactions, he will not be held liable. Only after he becomes a partner, you can hold him answerable. But even before he became a partner, even before that, if any transactions happened, for them we can't hold him answerable. So is Bheem liable to Mr. Sharma for LLP debts incurred before his admission? No, before his admission, whatever happened in the LLP, we can't hold him liable. Then is Arjun personally liable for LLP obligations arising from false statement of accounts and solvency not filed within time? See, Arjun is a designated partner. If there is any legal non-compliance, if the LLP has any non-compliance, any legal issue, then for that, whatever is a penalty, the designated partners will be liable, guys. In designated partners liability, you must have learned that they are the ones who are liable for legal compliance by the LLP. So if the LLP does not properly file the statement of accounts and solvency, there is a non-compliance. So for that non-compliance, whatever punishment is imposed, the designated partner will become personally liable. So yes. So no and yes, option B. Alright. So that's it, guys. We first discussed the 29 unique questions from the question paper from the RTP and the MTP, and then we saw these 6 case scenarios from the Jan 26 question paper. So with these, we are done with these 35 unique questions Jan 26 exam onwards. So with this, in the new resources, whatever were the new and unique questions, I've discussed them all with you. That's it, guys. With this, I think we are good to close.